All right. Good morning. It is a good morning. If you could all send me a tweet, let me know that you can see my chart and you can hear my voice. You gotta be very careful not to speak too loud because I'm behind enemy lines here. My wife is still sleeping. And if I do this correctly and I'm successful, I can pull this off and run over to Twitter and do a shotgun Saturday too. She spent too much time last night reading her Kindle and she's sleeping in. So let's do this. Is the audio good? Give me a 5x5 on Twitter. Thank you, Tabor. Just want to get one more person to confirm that they can hear. Awesome. Thank you so much. I don't want to say your name and mispronounce it. All right. So the market yesterday performed rather handsomely. And if you haven't watched the September 29th, 2023 live stream, which will be the video right before this one in the 2023 mentorship playlist of my YouTube channel, watch that one first. Okay. Even though you're here watching live, don't view that as advantageous because we're live, because everything's going to be recorded. The things I'm going to talk about here won't be as impactful as if you were to go and look at what was done live yesterday before it happened. Okay, so it's real important that you have that mindset, because it's many times if I drop something or upload something or teach on something, the new shiny object syndrome kicks in, and you only want to worry about that very new thing versus staying steady with your understanding, work with something that's already been given to you so that we can progress properly. And plus, it's just fun seeing it before it happens and then watching it after the fact. All right, so here's the daily chart of the dollar index. I mentioned that I'm not done with higher upside. I think that we're going to still move higher. This inefficiency in here, we mentioned that yesterday live. And we worked past it a little bit, but that's reasonable. You also have to remember that this wick in here, you have to draw that out. We hit pretty much that level, just a little bit past it, which, for your notes, when we are talking about wicks and the consequent encroachment of that, I treat that PD array the same way I treat a volume imbalance. A volume imbalance is this: a separation between two candlestick bodies. They can be connected with their wicks, but the separation between the two, that makes it a volume imbalance. Volume imbalance and consequent encroachment of wicks or tails of a candlestick, they are, in my mind, permitted to be traded through, and they can be revisited. But the context is it's going there to allow for trades to be taken in between these two boundaries, okay, the bodies of the candles. So that's why you're going to see this right here. Many times when I've talked about volume imbalances, folks expect them to be so pinpoint precise, like a order block's opening price or a fair value gap high and low, okay, where many times they can act as the very definitive boundaries. Volume imbalances and consequent encroachments of wicks, you have to be flexible with them. Okay, allowing them to be a target is wonderful. Allowing them to be reached into as a beginning of a setup, but not holding true to they only stop. They absolutely can be pinpoint precise, but there's a certain characteristic that you have to allow for those specific PD arrays. Now, it's not in the sense that allow for 50 handles past it, 10 handles past it, but just coloring outside the lines just a little bit more than would be acceptable for a fair value gap. Like acceptable for a fair value gap would be like a small little movement outside the high or outside the low of it, and which is what I call mohawk. A consequent encroachment or volume imbalance, it can go past it just a little bit, and for the sake of general rule of thumb, it can go, for futures, it can go 1.5 to 3 handles past it. Once it goes past that, then it would have to revisit it, coming back up to it, and then show respect of it there. And that's how I would use it. But if it goes beyond that measure, and for Forex, you would use it for like 3 to 5 pips. Futures is a little bit tighter because it's a more gentlemanly market. Forex is a little bit more Wild West still. So because of the broker spreads and the variance between what broker you may be trading with, they can open their in-house liquidity up on you and run against you because you're not really trading in the same pool of liquidity like a futures market is. Everybody's trading the same liquidity. Forex, it simply is not as advantageous for precision. It can be. You've seen me do it. You've seen my students do it. But I'm speaking in the specifics about a volume imbalance and or a consequent encroachment and the allowance for moving beyond it and still being acceptable as a PD array. So just make sure you put that in your notes. But we came off after hitting consequent encroachment of the wick here. Came back up and closed high on the day. I want to see over the next 2 weeks it work through this high and dig up into this imbalance up here. And in case you missed it at the beginning of the live stream or didn't watch the other ones and you just simply don't want to listen to the proper way of watching my content, the inefficiency is over here and it's rooted on the weekly chart. That's this inefficiency right here. Okay, on that candle right there. So the next candle to the right there, that candle's high, that candle's low. That is the SIBI, S-I-B-I, SIBI. Sell side imbalance, buy side inefficiency. And we talked about how Friday's news drivers here would be a factor. And I talked about how the importance of understanding how 2 high impact news drivers in the same session, meaning that we had 8:30 core PCE price index, and then we had a 10 o'clock revised consumer sentiment number. So with that, it brings the likelihood of a choppy market, which is predictable. And the main takeaway I was teaching yesterday is treat it like a FOMC or a non-farm payroll event, where it's a 2-stage delivery. Whatever has taken place with London and or the 8:30 news, the 10 o'clock news many times does the opposite, which is exactly why I outlined yesterday live in front of all of you that were there, how 10 o'clock would be used to run up into for Nasdaq, and we'll get to that in the details. But overall, all the markets reacted the same way. They ran up, and 10 o'clock, they dumped, and they went lower. How did I know that? The rules that I outlined in the live stream on the 29th of September 2023. I literally gave you what would be the equivalent of 4 chapters in a book that I can't really trust teaching just by typing out and putting charts in a book. Those lessons can't be conveyed properly. They're too dynamic, so they have to be shown in a real live setting, which is what I did it for. So in my book, you're going to actually see me refer to that very live stream. And if you were there live, you're part of history in that book because you saw it actually happen then. You were there. So a lot of the things in my books will lean on this YouTube channel because the lessons that I'm teaching here, they have to be done in a live setting. They can't be appreciated, they can't be absorbed or learned properly unless they are shown live. A static chart won't do it. Okay, so hopefully you guys can appreciate that. The book and the books rather will be dynamic in that capacity, because that way it'll allow you to take your attention to a real video where moving candlesticks will be there, and you'll hear me give you a better explanation, more details, the logic, what I'm thinking, why I'm thinking it. Friday's video live stream was, in my mind, something that I wanted to have as a new student, in the early 90s, when I was craving someone to be able to tell me, first of all, it can be done. Two, there's a rhyme or reason to what these markets are trying to do. They're not just doing something that's unpredictable. And if I had that, I would have not lost the drive that I did several times early on, where I wanted to quit and not want to do it anymore. So hopefully these types of lessons will build your confidence up and help you get through things when it's not working so clearly for you. All right, and you can see how we, on the hourly chart, I'm not going to drop any lower than an hourly chart today, but we dropped down into that fair value gap on the daily chart, went through it down in the order block over here, right there, and then pulled back off, which is what we're looking for. These highs here, like I said, these are suspect to me. I think that we'll want to revisit them. Do we go all the way up into that weekly inefficiency up here? I'd like to see it do it. I'd like to see that very thing happen, but I'm not demanding that it happens on Monday or Tuesday or something like that. But over time, over the next 2 weeks, that's like the time horizon I'm allowing for and looking for. I think it would be realistic for it to get up in there within the next 2 weeks. What does that mean? That means I'm allowing for potential range bound, and then we'll see what we get. But I'm not bearish on dollars. That way we understand things going forward. Back to the daily chart. And euro dollar. All right, so I gave you something in the live stream on Friday to work with, and it was based on this fair value gap here. I said you can go down to lower time frames and aim for that as an upside objective. On the hourly chart, you can see that that's what we got. Look at the bodies respecting that. I love seeing that. It never gets old. It stays inside the imbalance. And every time it had these little wicks above it, the shaded area, okay, that shaded area is the fair value gap that's highlighted on the daily chart. Let me take you back up to it so that way you're following along. The difference between this candle's low, look right up here, upper left-hand corner, right up here. This candle's low is the high of the fair value gap that's being shaded in blue. This is the SIBI, one directional candle down, and then the next candle after it, it's high, right up here, upper left-hand corner. That high is the low of the fair value gap that's making this shaded box here. Okay, so zoomed in. That's that gap, okay? This is permissible. Okay, this is perfectly acceptable. It's not something to be alarmed of or concerned about. When it's happening, every time it trades into a fair value gap, anticipate it happening. It's just like when you were a child and you had a crayon. Your coloring isn't always going to stay inside the lines. It's okay. It's fine. If your child was coloring a picture for you and they colored outside the lines, are you going to critique them and say, look what you just did there. You're failing. This is miserable. I'm not going to put this on my desk at work. It's not going to hang on our refrigerator in the kitchen. Of course you wouldn't do that. So when I look at this and I see my algorithm priced like this, it's acceptable. I don't look at it and judge it and say, oh, look, you didn't do this right. This is part of it. This is what it's supposed to do sometimes, because it's allowing for that high of the fair value gap, which is this candle's low, to get that price, it has to go what? It has to go one tick above it. So what's the low of that candle? 61.5. What's the high of this candle here? 61.72. So it's just a little bit above. For a second there, I thought I was talking about a futures market. I was expecting it to be one tick. But it's just a little bit past it in terms of pips and pipettes, which is completely acceptable. And then the market did exactly what we were looking for. Looking for it to recede and move lower. There we go, it's better. So this, folks, in case you don't know what this is a market maker sell model. Oh my goodness, he's talking about the good stuff. All right, so here's the fair value gap where the market could reach up into. And then it does what? What is it doing here? Right there. First of all, in this area here, this is smart money reversal. You watched me do that live in the Nasdaq yesterday after outlining it for 2 hours in front of 30,000 people watching it live, that Nasdaq would go up into its respective fair value gap on, I believe, at the hourly chart, fair value gap, and then use that 10 o'clock sentiment number to create the high and then trade down and run out the London low. Go look at your chart, pause the video, you're welcome to do that now, and go and watch and see if your chart did the same thing. And it did. Everybody watched the same thing happen. Well, I was using the same logic there. I was treating this run up with the idea that we were going up to reverse. I was building the entire narrative in front of every one of you yesterday that watched the live stream, or if you haven't watched it, listen to it in the recording. It's unedited. Having a draw on liquidity above the marketplace. You have to understand, is it a draw for the purposes of just simply getting out of a long position as a target, which I held no trade long yesterday. I was not in a trade yet. In fact, I had no real intentions of taking one until I saw somebody share on social media, a loudmouth, saying that if I was believing that this stuff would work, I would take a trade using it. So it was safe for me to say, I'm not going to do it. Well, then I did it. And now they're quiet. So I answer the trolls because I love the fact that we can shut them down with the proof and the evidence that this stuff works. It's not enough that they see everybody else making money with it and I'm calling it before it happens. They got to look for something that they can still crow about. So I love twisting the knife when it's in them deep. But this area up here is a fair value gap that I outlined on the daily chart that it could draw up into. It did. And then at that point, was it something that we would use for continued higher prices? That's not what I was communicating to you this week. The context is this was a target for upside, but if I'm bearish, if I'm holding on to an idea that the dollar index is still likely to go higher, this promotes the idea that if I can see a shift in market structure that's bearish at this point, and to the left, do I see smooth plateaus and consolidations that were graduated in steps? Meaning, here's one right here. Here's one right here. So I ignore this. I'm going to show you exactly what I'm talking about right here. So many people try to teach my market maker sell model and buy model, and they think it's Wyckoff, and they're absolutely out of their fucking mind because it's not Wyckoff. I don't care how many times you say it, it doesn't make it true. As I said before, if Wyckoff was alive, he'd be a student and he'd be subscribed to my YouTube channel and he would have joined my paid mentorship. So I ignore this. My focus is this range here. So I'll borrow this now that I'm saying that all this is being ignored. And your questioning is why? Listen, I'm about to explain it. There you go, right there. And that would be there. And on the diagrams, when you see me teach the market maker sell model, This is always referred to as the original consolidation. Resting below this is sell side. I'm getting carried away already. I got to make sure I get through this quick because I know what will happen. My wife will wake up and she'll know I'm up here, but she'll send me a text message, which you won't hear, but I'll see my phone light up, and then it's going to break my concentration, and then we'll have to break away. But I'll try to get through as fast as I can, but still be as complete as I possibly can make it. All right, so here's original consolidation, reaccumulation, smart money reversal, okay, low risk sell, right there, redistribution, and in here we're forming what I believe is the second stage of redistribution. That is one of the strongest trade setups that I love to look for. What makes this not a 100% absolutely go in there and trade it with a lot of leverage? Like, there are setups that I'll do that for, where I'll risk 5% of my account on a setup like that. And some of you are like, well, 5%, that's not a lot. It actually is a lot. That's a lot. Usually anywhere 1.5 to 2.25% is generally what I'm risking. But if I'm being competitive, if I'm really trying to push the envelope of what I should be trying to do at all, and would be outside the parameters of any of my students, because I don't think any of you should be risking more than 1%. Frankly, I don't think any of you should be trading more than 1% at all, because you don't have the experience, and it's probably going to serve you better to do it like that. And you think that you have to do big risk to make a lot of money because you're inconsistent. So the wins that you might get infrequently, you need them to be big because your skill set and your consistency isn't there yet. So a professionally minded trader that has a model that works very well, they're accepting and they receive the instruction of trading with low leverage as good instruction. It's good medicine because the model will carry it. The model, the experience, the skill set of the trader will carry it with low leverage, and you'll make lots of money over time, not lots of money in a lottery windfall. You don't want that in your trading. If that's what you want, you're not really trying to learn how to trade. You're gambling. So before I get into this, I want you to see what makes this one of those trades where it's not a high degree of let's put a lot of risk on it. We went down below. I lost my train of thought on the daily. Okay, here's the low we were aiming for on the daily chart over here, which is 105.16 and 2 pipettes right over on the right hand side. Dropping back down into lower time frame. This consolidation, we're inside of what would be a second stage redistribution, which is the opposite of what this is. Like, here's technically it's the first accumulation, then it's reaccumulation. There can be a second stage reaccumulation, but if it reaches the target that you'd be reaching for, which was the liquidity over here, and the inefficiency on the daily chart, which is that shaded area that I outlined on the daily chart, once it gets here, there's no necessity for a second stage reaccumulation. I teach it to allow for and look for it. If it pauses between the first stage of reaccumulation, if it creates another one in here and pauses, okay, that's the second stage reaccumulation. It's no problem. It's just one more thing to refer to on the other side of the curve. And the other side of the curve is everything to the right of the high at the target you would be reaching for, where you would anticipate and expect smart money reversal up here. The absence of another consolidation here doesn't make it any less of a market maker sell model. It just means that it was in a hurry to get up to this level. That's wonderful. We want to see that. Once it breaks away from there, it comes back up and gives us a low risk, high probability entry. Okay. And you might miss that one. Your experience level might not be there. It might not allow for you to see it happening. It's okay. The ones that come after that, which is here, this is first stage distribution. The one after this that's lower is called second stage redistribution. That second stage redistribution, if, okay, this is what distinguishes the trades where I'll take a maximum leverage trade versus a trade that I'll take and risk 1.25%, maybe 2% on. I would sell short if everything opens up on Sunday that would keep this intact. I would sell short, and I'm not trading Forex, so that way you understand. I'm not telling you to do this, but hypothetically speaking, if I were trading Forex, I would feel comfortable taking a trade in Forex and trading the euro with the expectation that we would run below these lows here. And that would be my only objective. Now, had this low on the daily chart down here at 105.16 and 2 pipettes, had that not been traded to and through yet, I would be risking 5% of my account to aim for this level here and go lower on the market structure that's in here right here. If you listen to me correctly, that was not an invitation for you to over leverage your account and try to trade what I just told you. This is not the high probability low. This is, in my mind, where I think it can sweep. But because we've already went below here, it could do this. It can go down here and then come back up and consolidate and frustrate you. And you don't want to be on your highest risk or leverage on a trade like that. So there's levels of understanding what makes a trade high probability. There's levels to understanding a trade that's high probability but still not maximum leverage. So there's a lot of things that you have to weigh out. And you thought, again, it was just give me a 5-minute video and I don't know how to trade. No, you have to know what you're doing when you're going to reach for high leverage. Should you trade with high leverage? No, I don't think you should. But eventually, if you get the skill set that you're consistent, there's going to be times when you just really want to go full bore. And you're going to test that. You're going to tempt yourself to risk fate. And it might be kind to you, which is bad because you'll want to do it again and try to make it your steady diet. And you don't want to do that. I promise you, you don't want to do that. But there are times, and you've watched me in the last 10 years, I've taken Forex accounts and I've ran them up from very, very small balances to millions. And they were not done with the MT4 rented server. They were traded with 5% risk on every entry, on every partial, every pyramided entry. For instance, if I built a position up and I had 7 entries, every new entry was using 5% risk on its independent entry. So that was like, collectively, it could have been a total wipeout of 20% if it would have pulled back against the original entry, which was highly unlikely. But that, in theory, that's what it would have been. But that's competitive. That was me basically saying, look, there's nothing else out here like this. Okay, nothing else. Nobody's going to be able to do this. Okay, and no one's ever been able to do it. Now, people with these fake white label, fake brokers, white label MT4 servers, which I swear to God Almighty, I've never done that. I don't even know how to do it. I'm aware of it. It was brought to everyone's attention by, I can't remember his last name now. Adam something. Anyway, he came out and he did a really good expose of how it's done. And I've never done that. And clearly you can see, I can read these markets like the back of my hand. Every 1 minute candle, second chart, like it's precise. I don't need fake stuff. I don't need that. You don't need to fake anything. And if you know what you're doing, you'll be open about it. You'll be able to go out here in a live stream, explain exactly what you think is going to happen. And I've done this so many times. I've done live trades in the live streams. I'd literally done it. Go back and watch them. They're there. They're there. If you don't want to look for them, of course, you're never going to see it. And you can clearly see that I'm outlining these things live. The whole narrative that was outlined yesterday was given to you over Nasdaq. I told you what I wanted to see in gold. I told you what I wanted to see in pound, euro, dollar. I was wrong in Aussie dollar. We'll look at that in a couple minutes. But I don't need fake trickery. I don't need to deceive you with anything. I have no problem. I could literally go out here in front of a court. I can stand in front of the Commodity Futures Trading Commission and do what I did yesterday. I ain't afraid. I ain't ashamed. I ain't scared. I am not without skill. I can do this. Okay. I am not afraid of anybody that wants to say anything negative about what it is you're learning from me. I'm absolutely cool like a cucumber. I could sit out here and do this every single day. And that's not bragging. I'm telling you that if you're learning from someone, they should be willing to do that. And when they do it, they shouldn't fall on their face. They should not fail. They should not be able to, they should rather be able to be consistent with the things that they're outlining, and you should see the evidence of it. And I'm asking you, did you see that yesterday? Have you seen it in my analysis that I shared beforehand on the higher time frame daily charts? Of course you're seeing it. Of course you're going to see it. And I told you, as I get closer and closer to the 11th of November, you're going to see this shift. More people are starting to come forward, and they're going to try to take away your desire to learn this. And they're going to try to put bullshit out there because they can't make money trading and they want ad revenue. Because when I go away on YouTube and Twitter, there's going to be a void. And everybody's going to be rushing in there to fill that up. And they want clicks. They want ad revenue. If they can't prove that they can trade, or whatever I've shown here proving before the fact and live in front of all of you, if they aren't dissecting that, everything else they're doing is bullshit. It's all lies. It's all horseshit. It's all horseshit. And I'm laughing at them because they're too pussyfoot to get into a real trading competition or come out here and do something that's better. These same people are failed traders. And social media, YouTube, Twitter, whatever, people clamor to that, just like an accident on the road when you're driving down the street. You don't really want to see anybody hurt, but you do want to see what that guy's leg looks like when it's separated from his body. It's human nature. But don't waste your time with people that are going to try to say that what you're witnessing, what you're seeing people all around the world do with real money, making real money consistently, it works. And because they can't do it, or they're trying to sell something that makes them a profit that isn't this, there's your ulterior motive. Of course they're going to say something, but they can't beat it. They can't even compare to this. Nothing compares to this. This is the market. This is the algorithm. I'm telling you exactly how price is going to book, why it should book. And I'm giving you the subtle nuances in the long-winded deliveries. So that way you know that you can trust the logic, because the questions that I'm tackling when I talk about the long-winded things, if you are really trying to do this, eventually you're going to come up against the wall and you're going to have that problem. You're going to have that thing that you have to decide, what do I do at this moment? Well, that's what I've talked about. I've talked about those very things. Like, when do I use maximum leverage? Whatever that maximum leverage is, when do you do it? Some of you want to do competitions. I have students that want to go into the Robbins Cup next year. Awesome. And they're asking me, when do I push it hard? Okay, well, I'm giving you an example right now. This is one time where I can see a setup that I would like to take a trade on, but I would not risk the maximum on. That's a lesson in and of itself. But you can't appreciate that because you've never traded. You're trying to, in a rush, you're trying to get out there and start pushing buttons when you don't know what you're doing, hoping that it works out for you. And that'll be the encouragement for you to keep doing it. That's the wrong way to learn how to trade. Just like going out there with a live account. Oh, even if it's a small amount of money. Bullshit. That's the word. If people tell you that, that's the person you don't listen to. You don't listen to people that tell you to do that, because it creates bad habits and toxic thinking. It makes you fearful of the outcome of each trade. Whereas in the beginning, when you're not even trading with a demo account and you're tape reading, that's confidence building. When it doesn't work out in your favor, did you have a loss? No. Do you feel like you wasted your time? No. You're observing. You're in discovery. You're trying to figure out, is there a rhyme or reason behind price? And if you don't submit yourself to that process, trading is going to be harder than it needs to be. It's going to take you longer. See, you're trying to avoid this long, arduous task of what I'm trying to put my students through, which is the optimal way of learning. But you think it's too long. And then when people try to shortcut it, they always fucking fail. They fail. And I've been trying to avoid that for you. I'm trying to help you get there the quickest possible way, but in a manner that is constructive, that allows you to get there and you enjoy the process. You don't feel rushed. You don't have high expectations that you're not going to be able to reach or meet and then feel discouraged. That's how I teach. I teach that way you feel like you're growing at a normal pace that is normal for you to feel like you're not there yet. Even when you're consistently profitable, you're not there yet. Otherwise, you'd stop trading, right? So you're never there. The destination is always constantly being reached for. It's why destination excellence. That's why I teach that. You're constantly looking to arrive there. I'm aiming for perfection. I know I'm not going to hit it. I'm aiming for 100% student base, success. I know I'm not going to hit it realistically, but I'm aiming for that. When I work for all of you to do this, and I create content for you to do this, when I talk on Twitter Spaces that are unmonetized, there's no monetization. When I'm done with this, if I can pull it off, I'm going to run over to Twitter, and I'll probably talk to you until my wife wakes up. There's no ad revenue there. I'm coaching your mindset. That's the stuff and the perspective you need to have, whether you're trading with my concepts or not. Because these markets will kick your fucking ass, and you will do it to yourself, and you'll blame everybody else. You'll blame me. You'll blame my concepts, somebody else's horseshit, some other book, some other influencer. That's somebody else's fault but yours. And when I talk, I'm teaching you how to wrestle all that stuff, because as a trader, that's coming at you every single day. And when you do it wrong, it hurts. It hurts your feelings. It hurts your pride. It hurts your ego. It makes you doubt. It causes, makes you second guess what you're doing it for. And is it possible? And you have to have a way to see past that, because it's so easy to just reach for someone else as the blame for you failing. But all these things I'm talking about matter. And because you have never traded and you just started, you have no idea what it feels like to have a winning trade with real money. You don't have any idea what it feels like to have a winning month, net profitable, a year profitable. But when you start getting into those times where you've been doing it for a little while, you're going to be met with a decision that you need to make. I see a trade there. How much should I risk? Should I reach for that maximum leverage right now? Could I really afford to do a trade where if it pans out, I could potentially do very well? I'm telling you, try not to do that ever. But I know human behavior. I mean, I did this stuff too. Okay? I know. Greed is going to tap you on the shoulder, and kid ego inside of you is going to rise up and say, I could do that. Of course I can do that. Let me do it. And then you fuck around and find out. But the times that I have in the past elected to use maximum leverage, it's when I can see a trade has all things going for it. So I said that, and I took a long way and a long walk around the barn to just make it clear that while I do subscribe to the idea that this is going to take this low out here, which would complete the market maker sell model, for this fractal, there's a larger one here. So what I'm doing here with this rectangle, highlighting this consolidation, that is here too. But because this is below a daily low that has already traded below, I'm putting that to the side and thinking, okay, we may take this low out and take the sell side, and that's a wonderful setup, great. But it might return back into the range between whatever low it takes here and makes the lower low, but not go below this low yet, and this high, that range between whatever low forms after taking the sell side and this high, it can bounce around in there and then eventually maybe go lower and take this out. I don't like to sit in those types of trades. I want to be in it. I want to like a one night stand. I want to hit it and quit it. I don't want to be in there wasting time, spending mental capital. When I'm in the market, I want to go into trades that I know that where I'm entering, it's not wanting to spend a lot of time. It's It's showing up for me to get in, ride shotgun with it, takes off, burns rubber, runs to the finish line. Fun, great, awesome. I'll see you next time. I'm out of here. That's how I trade hit and run strategy. Even if I'm trading over hours, that same approach and mindset that I'm thinking about that trade, I know what I'm looking for, and I don't want to hold on to it for days. The way the markets are trading now, I don't want to be in overnight risk. Anything can happen. Anything can happen right now that can cause a absolute destruction to anyone's trading. And I'm very, very cognizant of that risk, and I'm trying to convey that to you. And I think that risk is directly in futures. No, not sorry, forex, not futures. I think there's going to be decoupling in currencies. So that's why I'm telling you, you shouldn't be doing maximum leverage. But even in the lowest leverage, if what I'm thinking may happen, and I can't predict what market it's going to be in, I can't tell you the day it's going to happen. I know we're in a season where something really bad is going to happen, and it's enough for me to not be in that asset class. So I'd say that. So I want you to understand that there's a real reason why I'm not trading forex. It's not because it stopped working. It doesn't mean that you can't see setups or find setups. It just means that I'm not personally willing to do it because the incurred risk in it right now is enough for me to say, no, thank you. I'll go back to where I started. And the roots of where I started trading in 1990 was the futures market, the commodity market. So anyway, that's where I think we're going to draw to here. And if we get overzealous, we can go back down below here, make lower lows, which I think ultimately is where we're going. If we're going higher on dollar, this is where it's going to go. But much like I said in the dollar index commentary, we could consolidate a little bit. I'm not expecting a sudden straight run up on dollar, and the same thing would be expected in the opposite for euro. I'm not expecting some sudden drop in the bottom fall of it, and we're down here in a day. And I don't expect that. Can it happen? Sure. If it happens, I'll be like, wow, it did it. But I'm just thankful that it went where I thought it was going to go. I'm not trying to predict the time element of it because that part, I don't see it here yet. There are times when I can say it should be doing this by this. But when I don't have that advantage in reading the price and we're up against a weekend, which is always uncertain, I don't know where we're going to open on Sunday. So that's why I have to keep my commentary reserved enough to know that while I'm expecting this to be traded to, what happens if we open up here on euro? Well, then I'm done. I'm not going to be expecting this to be traded to. I would have to wait for it to break down again, and to break down below here to create something new doesn't allow me enough range to warrant a trade there. So again, what I just said there, that's not enough space or bandwidth in a book to be able to communicate that effectively. There's a lot of things that I just covered that in a book would not satisfy, at least for me as the writer. I can't convey it in no manner where it would be satisfying as the author. So that's why I like doing video teaching. And I'm lengthy because I'm writing a fucking book every time I sit down with you. All right, so let's go to the daily chart. Move over to cable. All right, so here's British pound versus US dollar. I talked about how eventually I do believe if the dollar goes higher, we're going to run that low. But again, we're not looking for a straight shot. It's going to be a gradual reach to it. We talked about this wick in here. We traded into it just a little bit above it. Remember what I was mentioning earlier in this video or this live stream. Consequent encroachment and volume imbalances we can allow for, then the color past it. Okay, just outside the lines. This is just a little bit like what I teach with the fair value gap parameters, the high and the low of fair value gaps. It's usually like one tick, maybe two at most. It's not usually a full handle in futures. I know we're talking about Forex, but I have to give it in the same light a explanation so that way, because I get so many questions. Does this work in Forex? Does this work in futures? What's the rules for this? What's the rules? I try to compromise with both communities because I know some of you are predominantly only Forex, and many of you are waking up and realizing that futures are a better marketplace and they're much more precise, and there's a lot less tomfoolery going on because of the broker aspects and the in-house liquidity where they can open up on you Your high may be past what everybody else's high was, but it allowed for your stop to be taken. That's the bullshit that goes on in Forex. Futures, we don't have that problem. Futures are a gentleman's market. That means it's highly refined. It's extremely precise. There's no fuckery like we see in Forex. Forex, it's still got some wild shit that goes on in it, which sometimes can be fun. If it helps you and it works in your favor, it's great. But many times it's not as advantageous as it would be for futures. Like futures, I could go in there and trade with a one handle stop loss. That's 4 ticks. I'm not about to try to trade with 4 pipettes in a in a Forex pair. And I'm fucking good. I'm not going to do that. I would never attempt to do that because the spread alone, they can open it up. Done. It's over. In futures, I can pull that off pretty consistently. I wouldn't even attempt it at all in Forex. So that kind of like helps you understand what makes it a gentleman's market versus the Wild Wild West. Hopefully that kind of like gives you a reason to anticipate, or not anticipate, that to understand why I reached for that type of analogy, that futures is a better market. It's more refined. It's polished. Everybody has the same high. Everybody has the same low. Everything agrees. Try that with your Oanda, Forex.com, whatever, Tom, Dick, and Harry's Forex broker, whatever it is, they're all going to disagree. And that it's a big red flag for you if you want highly precise elements in your trading to be consistent. And when you try to trade with real big leverage and you're trying to trade with these really small stop losses in Forex, that's why you're getting hurt, because you're trying to beat the broker that's absolutely going to cannibalize you in Forex. It's going to happen. I'm going to be honest with you. If I had a Forex brokerage firm and your stop loss was within range where I could open up the spread legally, that you signed an agreement allowing for that to happen, and you don't even read the agreements when you sign it, but that's what you just did. You gave them permission that they can do that to your account. I would do it to you. I would open up the spread if you were if I owned a brokerage. I don't own a brokerage firm. I'm never going to open. I'm never going to open a brokerage firm. I'm never going to open up anything like that. But if I was running one, I would do it. That's my business. That's how I get money. Especially if I'm booking someone, I'm going to do that. That's the reality. I mean, you can't complain to the lion when you're in his mouth, when your neck is in his mouth, and you went out there and acted like a lunch. Well, don't be complaining when you're lunch. So anyway, I'm turning this into a Twitter space, and I apologize. But the wick here, I talked about that as a factor for GBP USD. And again, all things being equal, we were looking for weakness at 10 o'clock. And we would want to see lower prices come in on the heels of that consumer sentiment number or confidence number. I can't recall what it was. And the market traded lower, ended up having a lower close from its opening price. Now, I'm not stating that we turned here and go lower. It can. I'd love to see it do that very thing. I would like to see that. I want to see that. But I'm open to the idea that it might not just roll right on through that. It might spend a little bit of time in here. It might want to go a little bit higher. It's okay. But for day trading purposes, yesterday I was giving you some critical points that you need to be worried about and focusing on around the time element of 10 o'clock. An hourly chart. Here. Look at the reaction off that fair value gap. Just outside the lines of the low, that's a mohawk. That's completely permissible. It's just like your child coloring, and that one little crayon mark goes just outside the line. That's not a failure. That's not it's not something that you would fault and say that's a bad thing. This is completely reasonable. And then the market resumes going higher, reaching into, what time is this? 10. So that's 10 o'clock. And then the 10 o'clock news, when that consumer confidence number came out, and we were looking for what? We were looking for lower prices because we had built the narrative. I built the narrative yesterday in the live stream, explaining to you that I felt that all that run up on Thursday, Friday's London session, all of that was preamble just to take us into a short-term premium. So that way smart money could do what? Short that strength, sell into that strength. And then at 10 o'clock, what did it do? Well, here you see it again, lower prices. Okay. Moving back into the daily chart, we'll see where I got it wrong. I mentioned on Aussie dollar. I'll go to market calendar. ICT's talking about something where he did it wrong. Prior to yesterday's live stream, I was mentioning that I wanted to see these lows taken out and upset that sell side. It did that. And then I mentioned that there was buy side here. And while we were watching price reach up, it could trade up into that buy side. And I said, watch that, because it might be something I don't see happen. And you can go on social media and share it. And this is the thing that IC said was going to happen. It didn't happen. And of course, laughed about whatever. And it didn't happen. Look at that. So I guess in a way I was still right, being wrong, right? I said, I'm probably wrong. There it is. But either way, I'm not interested in Australian dollar. I'm not interested in it. I wouldn't trade it. There's nothing in this pair that has me thinking anything at all that makes it feel like, oh, this is a great opportunity to trade right now. I will submit to you this. I do believe if the dollar goes higher, we will trade below this low here. This looks like bait. This looks like, come up here and run me out. I don't think that. I think they'll take this low here before they take these highs. That's what I'm going to submit to you here. That's the extent of my analysis for Aussie dollar. It's not trying to behave. So it's doing its own little thing. Like an Aussie would, right? So if we go over to gold, I'll quickly talk about that one. All right, and if you recall in the live stream, and the live streams prior to it, when I talked about gold, I don't like to trade this market. It's a very highly manipulated market. Gold prices should be extremely higher than they are right now. Gold should be priced, as I mentioned before, gold should be priced over $25,000. This is all suppressed. It's fake. They're keeping it artificially priced because they're accumulating lots of it. And when they put central bank digital currencies in play, the ones that are backed by a gold standard, you're going to see gold prices explode in its value once that occurs. So when these central bank digital currencies come online, and the ones that are being purported that they're backed by gold, that's why all the central banks, that's why all these countries are hoarding gold right now. Gold is eventually going to be worthless too. I believe the scripture says that in the last days, silver and gold is going to be thrown in the streets. They're going to cast their money basically in the street because it's going to be worthless. Okay, that may be analogous to what we're going to probably experience in the United States, which will be Venezuela 2.0, where our currency is literally shit paper, toilet paper. Okay, it really technically is right now, and that's why they're raiding it. Okay, they're running up everything real fast while there is a value, perceived value, but the goal is for us to be completely decimated, and that's the whole point. That's what you're watching unravel. So when the central bank digital currencies come online, and IMF just passed its testing phase, so they got a green light go. They could roll this thing out at any time. It could happen before the end of the year. It's definitely happening next year. Absolutely, definitely happening next year. Before we have our presidential election, if you believe that's going to happen, I'm not convinced that we will. That aspect of what I've been announcing and telling you to get ready for, once that happens, gold's going to go absolutely bonkers. But you have to be prepared for them to take you out if you're long. That means you're going to have a wild whipsaw drop. But after that, it's going to be vicious going to the upside. Like, it's going to be violently going up. Because they're going to be saying, okay, we have all the gold now. Now we can allow it to be priced at what it should be really valued at. And you'll never be able to afford buying it then. So that's how all this stuff's working. It's all the marionette strings, how it's all tied together. That's what's about to unfold. You don't see anybody talking about it, but that's what's really coming. But I think that ultimately, as I mentioned in the live stream on Friday. The sell side below here, that's where I believe that we're going to reach to for gold. But prior to that, I talked about how we could trade into this order block. It did that. We're inside of this inefficiency here. And taking all that away, like I said yesterday, I'm thinking ultimately this is where we're going to draw to. And then Friday, we had a really nice run. We went to the lower quarter or quadrant of this inefficiency. That's not quarters theory, folks. And so many people want to take, and he's teaching this, he's revamped this. It's $5 million. Again, I'll tell you every time I do this, $5 million for someone to sit down and literally go through why you believe that I renamed something else in existence. And I'm using that very thing because I promise you, everything I'm doing has absolutely no link to anything that's in any other book. Unless I specifically say this was inspired by either Larry Williams, and none of the things I'm trading with is Larry Williams. Larry Williams can't look at any of this stuff and say, yeah, that's my stuff. Chris Laurie can't sit here. I made Chris Laurie come out on Twitter and tell all of you that what I'm teaching is none of his shit. But you ignore it. You ignore it because it doesn't fit the narrative. You want me to be able to be pinned down and say, oh, he's copycatted somebody else and renamed it. That's not what this is, folks. That's not what this is. For folks that don't believe that, go and look at Twitter and scroll back a couple months ago. Because I told Chris Laurie, I said, I'm about to unload on a legal campaign on a few people. And I'm going to drag your ass into this because they're citing that I'm taking your content and rebranded it. So if you want to be part of that, let's go. And there it is. So he came out and told you the real thing. And he was man enough for that. I appreciate that. But the idea is that we're looking for lower prices on gold. Right under here. And we could bang around in between this high and that low in a sloppy manner, but ultimately gravitating towards that low here. Okay, so I hate gold. I literally hate it, and I have students that love it and do very well trading it consistently. It needs to be something event-driven for me to have any kind of interest in it. And I know many of you like me talking about it, just like you want to hear me and see me talk about Bitcoin, which I absolutely know fuck all about. I don't like it. I think it's ultimately going to go to zero. So that, and I mean that. I do believe it's absolutely going to be zero. It's going to be just like the NFT market, which is horseshit. When that came out, I was making fun of that too, saying this is an IQ test. How stupid are you? Okay, and a lot of people were stupid and bought dumb shit with it, and 99% of it's worthless. Crypto will fall the same way. You've been talking about XRP. It's going to be the next thing. It's going to be nothing. Okay, it's literally shit. Bitcoin is just the thing that everybody remembers. Oh yeah, this is what the hash is allowing Bitcoin and every crypto to exist on. It was built by NSA, and you all are being primed to accept central bank digital currencies. That's the reality that you don't see. You won't accept it until you're under the bondage of it. Then it'll be perfectly clear to you. It'll be hindsight perfect 2020. You'll say, "Oh shit, this is what was going on. We were just being allowed to trust it and be comfortable with it because it's a new form of money." That's a scary thing. And because there's a lot of things that I didn't want to talk about before things got set in motion, I was very careful about what I said. But I did tell you, and I'm telling you again, Bitcoin will absolutely be zero. Zero. You will not be seeing 100,000 Bitcoin. Okay, I promise you that will not happen. I will delete my fucking YouTube channel. That's the only way it's going to be deleted. I will delete every fucking video on my YouTube channel if Bitcoin goes to 100,000. There you go. It's not happening, folks. That's not happening. Okay, done. So we're going to go over to ES. I probably just made a lot of crypto students angry. Don't be mad at me. I'm not trying to incite pitchforks and torches. I'm just telling you that's my opinion. You don't have to agree with it. That's what makes this world go around. Especially that's how the markets work. There's got to be a bull and a bear, right? Sometimes you got to bear jokes and deal with the bullshit. All right, so Here is the daily chart of E-mini S&P, December contract. And as I mentioned yesterday in the live stream, very, very carefully go back and listen to it. Okay. For every market that I was saying, I had subtle nuances that I was telling you that I want to see and I don't want to see. I like this, I don't like that. Okay. All of that helps me frame a narrative. Okay. A narrative on what I think. And what is narrative for the folks that don't know what that means? That's not bias. A narrative is when prices are behaving a specific way, not necessarily running one direction. Okay, narrative many times is going to a direction for the purposes of creating a event, then a real move takes place. That's narrative. Okay, so it's kind of like a game plan. I think of it like a football player's coach. Okay, he teaches these players, and folks, listen, I'm not a sports fan. I don't fucking like football. I don't like any kind of sport like that. But I do understand that a coach teaches his players or her players a set of plays. Okay. You player A and you player B, you run this direction and you run that direction. And you, as a quarterback, you pass it to this person over here that no one will be paying attention to. And hopefully they can run to the goal. Okay. They don't just have one model, they don't have one play. So while in the beginning, you should be reaching for one to work with, eventually you're going to have a couple models, but you're always going to have that one flea flicker. You like that? You like that? I knew one play. That's about all the fuck I know. Okay. All I know is I had a friend in school that they thought that was the flea flicker. And I was like, that's a silly ass fucking name. I'm not going to play football because that's a gay ass name. So anyway, the point is this. Oh shit, social media's gonna come from. He said, it's gay. Who gives a fuck? Okay, who cares? The bottom line is that that coach is teaching you a multitude as an army, as a playing team, okay, a team of gladiators that's trying to overcome someone else's goalpost. That idea can't come on the heels of one approach or one attempt or one model. You have to have what? You have to have an arsenal. You have to have a way to navigate because that other team is going to have a defense. And they're going to be trying to run over you and keep you from getting that goal. So when we're looking at a narrative, I'm teaching you how you have to anticipate the likely scenarios. It's not a single scenario all the time. There's some times where I would be willing to expect or anticipate price behaving a specific way for this function to unfold in price. Run up to go into buy side. Why? Why would it want to go up the buy side? To take those participants out of the marketplace that were short or trick them into being going long for the very explicit purposes of going lower. To take that liquidity, use it as a counterparty to handshake with it and go lower and do what? Buy at a lower price below an old low where sell stops are resting and you have willing participants to sell to you at a low price. That's narrative. Bias, what makes the differentiation between bias and narrative? Narrative is a ebb and flow, a rhyme and reason. Bias is a one-directional premise. It's going up or it's going down. That's it. Now, narrative is the first thing that's required. Then once it gets to that event-driven price and time, then you have a bias. The bias is now bearish. The bias is now bullish. But prior to bias, there has to be a narrative that's understood by you. If you're sitting down in front of your charts instantly, okay, with no pretense or expected, what price may should do higher or lower, and you like, oh, I'm going to go in and start trading, you're gambling. You have to have something expected in price action. You have to anticipate it, know what it's likely to do. And if you don't do that or have that, you shouldn't ever try to enter. Because what you're doing is you're impulsively chasing what you think you see in the chart right then and there. Now, there is a practice, there's a drill I put my students through. I do it with myself still, is keep myself fresh, and real snappy with my decision making. And I teach my sons to look at it this way too, where they'll tell me a time frame, just come off the cuff with some kind of random number, and whatever that number is, I put that in as a time frame, and I have to immediately, as soon as the chart opens up when the markets are live, I tell them, okay, as soon as it opens up, it's there. I have to tell them where it's going to go to next, right then and there. That's a real fun thing to do. And it's fascinating to them when they see I'm right. But the few times that I'm wrong, it's okay. It's okay. And that's what it's going to be like for you when you first start to use these concepts. Sometimes it's going to work. And the few times that you're going to struggle with it, you need to see past it, because everything is going to be, far from 100%. Nobody's going to be 100%. I'm not 100%. You're not going to be 100%. And you have to accept that. So the way you accept it, the way you navigate price, the way you build a model and trust that model is having the understanding of a narrative in price. Why will price likely do a specific thing? And why shouldn't it do another thing? And by having that as the beginning foundations to what and why you're trading, then you can trust a bias. See, that's the part that all of you say, if ICT could just teach me how to know the bias and I could trust the bias all the time, I would make money. That's bullshit. You would screw it up somewhere else. You would rush to get in. You wouldn't use a stop loss, and normal static volatility would squeeze against you, and you'll close the trade, and then it'll go in where you thought it was, and you'll blame me or blame the concepts don't work. When they do, you just are fucking up. The idea of looking for bias is not the answer. Narrative is. Why should it behave a specific way? Why should it go to a specific pool of liquidity? Why should it reprice to an inefficiency? Because that's all it's doing. That's all price is doing. But if you try to go around or circumvent the need to determine a narrative, and you're trying to derive a bias without that stage or step in the process, that's why you're having a hard time determining bias. That's the missing part. But you don't want to listen to these long videos and discussions where I'm teaching you it. You want it to be easy. Like, get on the bike. I don't mind getting on the bike and falling off a few times, but as long as I figure it out in the hour and I'm pedaling and going around the neighborhood with my friends with their bikes, that's what I'm looking for. That's not how trading is. I wish it was like that. For my own children's sake, I wish it was like that. I wish it would have been like that for me. Yeah, for my paid students that paid me, I wish it would have been like that for them. Every one of my profitable students will honestly tell you it's harder than you think it's going to be. It's going to take longer than you want it to be. But if you want it, you'll submit to it and you'll get there at the right time. But for ES, I talked about, I did not, and go back and watch the live stream. I did not want to see it trade above these highs. Where when we get into the Nasdaq, I said, I do want to see it trade above that. But these specific highs here, I said, I don't want to see it trade above that. We want to see it trade up into buy side, running higher into the 10 o'clock hour. And let's drop into a 60-minute chart. Here's that inefficiency, and here's the buy side. I said, when we were trading here, I said it's likely to draw up to take that buy side, and any overzealous price action, it will trade into this inefficiency. I did not say it's going to go above this high. I did not say it's going to go up here. I said it would want to go into this area for the purpose of taking the buy side, but it's going to go into this right here. This is a SIBI, S-I-B-I, SIBI, sell side imbalance, buy side inefficiency. Hang on one second. All right. And what you want to do is you want to take a look at that. And anytime you have an inefficiency, this is not quarters theory. I have to keep doing that. I know it gets on your nerves when I do things like that, but you'd be surprised, if you're new here. So many people try to talk shit and say that I'm teaching something else and rebranding it, renaming it. Find quarters theory in this, okay? Because it's not there. Wyckoff doesn't even know about this. This inefficiency, you grade it, okay? Consequent encroachment is the midpoint. The lower quadrant down here, that's what it's respecting. Yeah, we have a little mohawk right here, but look at that candle and look at that candle there. You see that? That's not fucking random. That's absolutely controlled. It's programmed. It's going to do those things in the future too, okay? If it's bearish and we anticipate price going up into that level to take out the buy stops that are resting right above that high, how far can it go past that ICT? How far can I reasonably expect it to go so that way I can place a stop loss where I can sleep at night knowing that I'm doing things with a systematic approach that's not random. I know when I'm placing my stop loss, it's based on sound logic. It's not guesswork. Okay. For me, you have to consider the fact that we could trade above consequent encroachment, which is the midpoint. It can do that. How can it do it? Just like it did here, just a little bit past it. So if you're going to go short in here, you have to allow for your stop to be where? Just above this plus another handle. So 1.5 handles, 2 handles above consequent encroachment. If you're going to sell short here, your stop has to be at least 2 handles minimum, in my opinion, 2 handles above that level right there. I can't take that trade. Then you can't take that trade. I don't know why you can't take that trade, because there's micros. $5 per point. You're trying to tell me you can't risk 20 bucks? Risk 20 bucks to make a couple hundred? You're all looking for these high multiple trades, and you think you can't make money trading a micro. My son just showed it to you. Even though he finally met his demise with it, he got 2 payouts in 1 month. Inside of 1 month, he passed 3 express top step accounts, the $50,000 ones. Had 12 winning days in a row. Hit their leaderboard on their live stream. You see his name up there. And took 2 payouts when 90% club never get a payout. Many of them don't even get funded. He got funded on 3. Got 12 days consistently profitable and took 2 payouts inside of 1 month. So he destroyed the fucking stats. Son, if you're listening, that's not failure. I'm proud. I'm proud of you. But this area here, we talked about that yesterday, trading up into that, with the pretense that it's going up to go down. Where? To take out London low. Go back and listen. Go back and listen. It's all there. You can't cherry pick the bullshit and say, oh, he said this and said that. No, it's all there. Relative equal lows. These are how you want to study it, okay? It traded up here and pulled down to what? Just this low? No. It's really likely to be swept because there's 2 of them. I'm ignoring all this to the left. I don't care about that. I'm looking for areas where this is smooth. And smooth edges like to be made jagged. And the market pulls from this area here we talked about as a target that sets up a move that at 10 o'clock will go lower. What's this candle's time? 9 o'clock. Next candle right there where it's touching the lower quadrant of this range at 10 o'clock when the news comes out. What's the price doing? Dropping. At 11 o'clock, what's it doing? Dropping. 12, dropping. 1, dropping. Now, going into 2 o'clock on a Friday, you're in the latter portions of the daily range. We've already seen the manipulation, the profit release portion of the run. Relative equal low, sell side is taken. Now time, what are we doing? We're going to consolidate off of the low. Pull off the low, consolidate, there's your close. We have open, high, low, close, power 3, all around the element of that event at 10 o'clock. Power 3 is not limited just to the daily range. You can look at it on a fractal basis. So everything that you look at in terms of price, every range can be utilized as power 3. There is an accumulation phase, a manipulation phase, a profit relation portion, or the biggest portion of the run, whether it be higher or lower, and then the close, where it comes off that extreme. Can you see that? Opening, rally, drop, close. Close is not on the low. The open is not at equal with the high. It's very cumbersome sometimes as a mentor, especially with so many different languages, to convey certain things. And the more I talk, and if I talk about things that have a slang term that many of you that are outside the United States may not be familiar with, these are things that I wish I could avoid doing, but because I'm here live, I don't have a filter. Obviously, you can hear. Sometimes I don't convey things as clearly or succinctly enough for the folks that are outside the English language. But I'm going to say the next few things as clear as I possibly can, so that way when YouTube does the compression and creates the transcript for this live stream, every translation can be seen to show and hopefully get what it is I'm trying to say. Every price run, every movement in price action, whether it goes up to go down or goes down to go up, every single one of those occurrences, every single one of those examples is a framework of my power of three concept. So if you know what's about to happen, your mindset should be, okay, it's going up to go down. So that means I want to watch how price will behave with that in mind. Opposite. If it's going down to go up, I'm going to be looking at the opening, or when I'm seeing the pattern form right before it drops to create the buy signal, I'm treating that as the open and manipulation. Then the profit release portion of that move will be the expansion higher. And then at some point when it reaches a target, I expect it to pull off of that because of the time element. So all those things together will start having a better effect on you being able to read price action. It's not limited to a daily candlestick, because a daily candlestick is simply one interval of measuring the fluctuations of price action. But there's ways of manipulating price in different time frames that are not many times even referred to by other people. And by having the exercise of going through time frames that are not classic, okay, and what do I mean by that? Like a 7-second chart, okay, a 3.5-hour chart. You might not see an inefficiency on the 4-hour chart. You might not see an inefficiency on the hourly chart. But what happens if you see it on a 2.5-hour or a 3-hour chart or a 3.25-hour chart? See, if you understand a narrative, you understand that the market's trying to do something specific to get to a destination, whether it be higher or lower in price. It's going up or down to go to liquidity above the marketplace or below the marketplace. Or if there is no run for the liquidity sake, it's going up to trade up into, like it did here, it's raiding the buy stops above here, but it's trading into this inefficiency. So it's not randomly reaching up there, clearly, because I outlined it yesterday and told you it was going to go there. And then I told you what was going to happen once it did. And it did. How can that be random? How can it be conjecture? It isn't. It's based on the things I'm teaching you. But you can't learn all these things and appreciate what's required in you practicing it and the time that it's required for you to learn it by just simply talking about it one time in a short little video. There's no way anyone can convey it and adequately teach it properly in a shorter capacity. The bandwidth, it needs to be broader for you to be able to receive all the details and the subtle nuances that's going to help you trust it. Because in fact, I've already said these things on Baby Pips in 2010, 2011, 2012. I said that. I said it in the short form. And not many people learned when I was doing it that way. So when I teach, I'm teaching it like I'm teaching it to myself at 20 years old. I don't give a fuck if you don't like how long it is. I don't care. I don't personally give a shit if you think I should be doing it short. I don't care. Because I know what I'm doing is the right way of doing it. It's giving you every aspect because I want to make sure that you know. There's no excuse. You can't come back and say, but you didn't teach me. Bullshit. I taught. And I gave all the details so that way when these questions that you don't see coming in your learning, I already know what questions you're going to ask. I already know where you're going to get sticking points and struggling. I know, and that's why I'm talking to you the way I'm talking to you. I want you to understand it. I want you to succeed. I want you to get this. I want you to. If I didn't want you to understand it, if I didn't want you to understand exactly how to walk out there eventually and not need to ever come back to this YouTube fucking channel, I wouldn't be pouring this much emphasis and effort and time into it. I want to make sure that you have no excuses why you couldn't do it. And no one's going to call me fucking lazy because I'm making sure that you have everything that you can have as an arsenal, a rhyme and reason why to trust it, that you can see it repeating over and over and over again. These characteristics, they repeat. And unless I keep pointing them out and beating it in your head saying, look, do you see that? That's happening for a reason. Do you see it? Do you see how it's behaving? Do you see how it's delivering price? Why it's doing that? Repetition builds recognition. You cannot recognize it on the hard right edge over here when the candlestick hasn't started forming yet. You can't see it there until you've seen it so many times on the left side and working with it and testing it and back testing and seeing it. Is it valid? Does it repeat? And there's no truer form of understanding it than me getting out here live in front of 30,000 people, sitting there in front of all of you, cutting up with you, talking. Did you hear any kind of anxiety in me yesterday? No, I knew what the fuck was going to happen. Okay, I knew exactly what was going to happen, and I walked you through it gingerly. That's not arrogance. I'm just telling you, some of you waste so much time worrying about what if it stops working? What if it doesn't? What if it doesn't stop working? And you fucked around and wasted time worrying about something that's never going to happen, and you could have been making money, helping your family, helping your ends get meet, your bills get paid. It's fascinating to see how many people have this being laid in their hands for free. For free. I could stop and put a PayPal link up and get millions of fucking dollars a month again. And you're arguing with me. What the fuck? I don't understand it. Like, I'm literally laying it in your hands for free and you're still arm wrestling me. I don't get it. But anyway, 15-minute time frame. Okay, the market trades up into inefficiency after taking the buy side. We have a shift in market structure here. Breaks lower. Where is the fair value gap that formed after the shift in market structure? Is it up in here? There is none, right? So where's the first fair value gap? There. So you have a fair value gap and a breaker. Coupled together, you have a lot of narrative there because it went to buy side. What's it going to reach for? Relative equal lows. Were they swept yet here? Did it get to it here? No. So there's range. Fair value gap. Is it going to close the entire range? Preferably, we don't want to see it do that. Oh, here he goes. He's talking to hindsight. It's perfect. He can see it. Look, dude, watch the live streams where I'm talking about before it happens on a 1-minute chart. We're talking about a 15-minute candlestick here. We want to see this stay open partially. Why? Because that would act as what? A breakaway gap. It means it's going to indicate that it's really heavy, and that term means it's bearish. Really bearish. It's likely to not want to go higher, and any attempt to try to go up will be stifled or limited, like this is here. And you can look at how price action here. ICT talks too many bad words in these live streams. Listen, I know I'm going to repent when I'm done. I hate it. I can't stand I do it. I wish I couldn't do it, but when I talk about the Bible, I never reach for those words. Isn't it interesting? Consequent encroachment. Small little mohawk above that. Right there. You see that? How many times have you seen it so far just today talking about price? Interesting, isn't it? To get that price in futures, it's got to go what? It's got to go above it by at least a tick. The bid and the ask is separated by what? That one tick, one tick in price. So 43.49 1/4. What's the high up here, upper left-hand corner? What's the high of that candle? 43.49.75. 2 ticks. That's reasonable. It's reasonable. Are you going to freak out because you went and sold short here and it's running up to here? Chances are, if you're brand new, you don't know how to read price action, you haven't been around me enough, you haven't been back testing, and you're not trading with the idea that the stop loss needs to be above this candle's high. What? That's what I teach. That's what I'm teaching you. But I can't trade that with 15 contracts on my top step combine. Well, fucking hello. You're not supposed to be doing it anyway. Why can't you get comfortable trading with 1 micro for a little while? 1 micro. One $5 per point futures contract and build your experience off of that. Because if you can be consistently profitable doing that and make $100 with that, you're making 20 handles. 20 fucking handles. That is enormous. If you can consistently do that a few times a week, let alone just one time a week, that's still beating up anybody out there that's classically trying to be a trader. Most of them fail. They can't see it because you're rushing to get to the big payout money. And that comes easily when you do all the groundwork of doing what it is necessary in the beginning. Just take the money out of it. Take that aspect away from it and get good at reading price, because once you can do this and you can see it happening before it happens and it's systematic and you can trust it, the process is not being too stressful for you. It's something you're comfortable in your skin while you're doing it. If you're not comfortable in your skin while you're trading, there's several warning signs there. Number one, you're over leveraging. Two, you probably aren't trading with a model. You're gambling right now. You're just doing something, pushing the button. Or you took somebody else's advice as a signal and you don't know what the fuck they're doing it for. You're just hoping and praying, because now you're religious, that they did it right. And when they win, you're an ace. Look at that trade. Woo, we're balling. High five, yeah. And when they lose and they do it wrong, you're quiet or complaining. Oh, this market so and so and so and so. But you'll be quick to follow that person's signal again. You'll do all the effort of making sure you show up into their live streams and show up to their Twitter feed posts and go into their Discords and go into their Telegram channels and fucking watch them lose. That takes effort. Well fucking done. Well done. You're consistently doing the wrong shit. All I'm asking you to do is move the dial just a little bit and start doing the things I'm telling you to do and avoid the things that you should be avoiding, and put that same effort, that same amount of effort, put that into just trying to make this work for you. I swear to you, you will see the results you're looking for. You will see it. And it'll become infectious and it'll feed you and you'll be like, I want more. I want more. That's why our community is a bunch of fucking savages. That's why we are savages. That's why every other community has an issue with us, because we love what we're doing. We're passionate. We know we can kick the fucking shit out of these markets and nothing else can touch us. There's nothing close to this. There's nothing remotely close to what we do here. Nothing else can compare. Nothing. I've baited, I've begged, I've pleaded. Please come out here and fucking show me that I don't know what the fuck I'm doing, because I will literally run circles around your fucking ass. And nobody ever fucking does it. Why? Because they see me smashing the fuck out of it. They see me calling every fucking tick on 1 minute candlesticks and taking $10,000. $15,000, $18 fucking $1,000, $30,000 fucking things. These things don't fucking happen by randomness. That's not fucking random. That is absolutely cool, calculated mechanic in action. And it's transferable knowledge. You can learn to do this. You can be a quiet, gentlemanly, eloquent person on social media, YouTube, if that's what you want to be. Or you could be a barbarian and go out there and smash everything and say, come at me, bro. I'm not trying to encourage that. But some of you want to do that. And if you do it, I'll be watching you. Everybody's going to bring their personality into it. But nobody can say this stuff doesn't work. Nobody can do that now. Nobody can do it. Nobody can say it's unprofitable and nobody can make any money, because I have the largest community online with the receipts showing it works. And I'm not trying to be adversarial to any of you that are selling stuff or trying to do mentorships or teaching whatever it is that you use. But I have to talk this way sometimes because I get inundated with people all the time giving me some Mickey Mouse bullshit arguments about, this person said this about you. What do you think? I think they're full of shit. If they could trade better, they'd prove it. If they want to make documentaries, make the documentaries about the things I'm doing live, how I'm trading with live fucking money, how I'm calling the markets beforehand, and it happens. Where's the arguments and documentaries about the students that are making almost millions of dollars now? Millionaires. I'm making fucking millionaires. Where's the documentary saying that's not happening? Because it's happening. It's fucking happening. Okay. For years, I've sat out here and I've taught and taught and taught and proved and proved and proved. I could literally go up into your fucking house, trade live in front of you, and you'll still critique me. The fuck out of here.
So let's go over to NQ and wrap this up because I got a Twitter space to get to. I got some shit to get off my chest. I'm warmed up now. What's a Twitter space? You don't want to hear it, trust me. All right, so daily chart. ICT's YouTube channel has been hacked. Who's this guy talking? This isn't the guy we hear in the videos. Yep, this is the guy that's filtered out. So that way I can sound a little bit more refined. But when I'm live, I can swing on both ends of the spectrum. All right, so on Nasdaq, in contrast to what I was talking about for ES, I did mention on ES that I did not want to see the relative equal highs that these two candles made, but I did say I wanted to see it for Nasdaq. Now, why did I say that? You ever think about that? Did it cross your mind as to why I would have said that? Because ES was the weaker of the two indices. That means it's more likely, it's more apt to reach for its lower targets. In other words, in plain terms, it's easier for ES to drop than it is to go up right now under the current market structure. Everything that's in play, as the ES and Nasdaq was going up, we talked about Nasdaq being the higher leader. In other words, while we were bullish, and we were bullish all through here, I was calling Nasdaq as the upside leader. That leader aspect is still in play because we're inside of this large range here. When we lose this definitively below these lows here, then Nasdaq will become decidedly weaker. It will start changing its characteristic as the leader, then now the leader to the downside. It'll start accelerating beyond what ES will do. That's the train of thought I'm holding. I'm trying to convey that to you now. That's all part of Six Sister concept. That part I'm kind of reserving for the book, because as soon as I teach something new, immediately somebody's putting a video out and they're putting a small little book together on Amazon, and they're trying to get ahead of me and putting it in print first. That's why a lot of the things I teach is abbreviated. They're just introductions. So when I release my books, the things that they don't know that they hurried and rushed and put into print will be incomplete. And while it's interesting to see dozens of books written about me and or my concepts, it's a little unfortunate because they're not accurate. It creates a lot of buzz around me, and that's cool, I guess. But unfortunately, the readers of those books aren't going to get the intended message or concept that I have as the author. But you'll have it from mine. But I talked about how the Nasdaq, I wanted to see it trade above these and then trade into this inefficiency up in here, and we saw that on Friday. So Wednesday created the low of the week after reaching into the relative equal lows, which was our target all through here. And the quarterly shift target is digging into this inefficiency. So while I don't believe that we're done doing that, it's usually right about now people are starting to think, this guy was absolutely going bonkers a minute ago, and now listen to him, he's back to being Mr. Rogers. Bob Ross again. Yeah, that's my life, man. So this is the quarterly shift. When we were up here, I said we were going to run this high there to go lower. The quarterly shift was down here. Price did in fact do that. Don't take my word for it because I'm saying it here. Go look at the videos and the live streams and the commentary videos I was doing that are time and date stamped. I don't have the ability to go back and edit them. So they're there for you to hold me to the fire. Did I say that? Did it happen? Go back and see it. We just poked our head into this area here. Okay. So we've done this much. Actually, let's do this. We've moved this far into that range. So what's left? This. So while this is completely reasonable, I've not abandoned the idea that we're going to go down here and trade deeper, because the ES, if I can go back to that chart real quick on the daily chart, it has done its respective full inefficiency here. So look at the date here, the June 2nd and the June 1st. Now go back to Nasdaq, and we have the inefficiency for it is on May 26th and 25th. So this inefficiency has just now been traded to here. Whereas ES is satisfied a run for lower discount inefficiency. Nasdaq had to get to this to trade for that purpose of going to sell side or sell stop below these relative equal lows, because smooth edges like to be made jagged. This was a little bit too shallow of a run below, in my opinion. If it's going to have this big smooth area in this gap by this one single candle, and then you have all this run up, this in my mind is too anemic. It's not enough to satisfy the fact that, yeah, there was probably some sell stops that were on a large fund level attack there. That's fine. But this is, in my mind, just going up to take out the trailed buy stops that are here and retrade into this inefficiency. So it accomplished two things. It took a run up into stopping out anyone that had a trailed stop loss, because after this big candle here and this candle opened up that day, everyone that had a trailed stop loss up in this area or in this area here, they rolled it right to this high or just above it. And now on Friday, they're gone, which was what I was building the narrative around when I was talking about all through the early portions of the live stream on the 29th of September 2023. So let's go into an hourly chart. All right, and that inefficiency on the daily that's the 4 hour right here. That's that gap. So if you're looking at the daily chart, what's it framed on? It's the 4 hour chart. That fair value gap. That candle's low on September 20th, 10 p.m. and the high of the September 21st at 6 a.m.'s high. And this again, this is a 4 hour chart. So that's that inefficiency range that I was showing here. And then the buy stops here framed on that swing high, and it can be easily seen here on the 60-minute chart. So you can see how the 4 hour doesn't show a fair value gap. And it was in concert with what the idea I was teaching a little while ago when I was saying you want to get comfortable with going through time frames that are not classically used. Like 4 hours is a classically used time frame. I mean, everybody does technical analysis less than a daily chart. They're familiar with a 4 hour chart. You might not use a 4 hour chart a lot, but when I go through time frames, like I'm not just limiting it to daily, 4 hour, hour, 15, 5, 1, all that. I'm looking at time frames that are outside the norm. Like I was saying earlier, there's 4 quarters or 15-minute intervals inside of a 60-minute chart. So one candlestick on an hourly chart is 4 15-minute candlesticks. But what happens when you look at 6 15-minute candlestick durations? You're going to see inefficiencies that won't necessarily be visible on the other time frames, whether it be the 4 quarters of a 15-minute inside of an hourly range or on the basis of a 60-minute hourly candlestick chart. So I'm trying to inspire you to look inside price at different intervals that are not classically used. So that way you'll see inefficiencies that most everyone else are just simply not aware of. And it'll give you a better feel for what it's really reaching for. Because, the algorithm is extremely complex, and it's cycling through a myriad of time frames, looking at the inefficiencies between consecutive candlesticks. Okay, we see them as a measurement of time. The algorithm works from the higher time frames down to the lower time frames, and then it cycles right back up again. Because it's computer, because it's an algorithm, it's running a macro, it's a script, it's constantly looking for these. And that's what's going on. It's not buying and selling pressure. You're going to sit and tell me that what we were doing yesterday live, when I was telling you those little tiny little minute discrepancies between 3 candles that create a volume imbalance or a fair value gap, that just random buying and selling pressure happened to align with those very specific turning points right to the tick. That's what you're going to argue. It takes more faith to believe that bullshit than it is that this is all rigged, it's controlled, it had an author, and All these things, these factors, are repeating over and over and over again. If the markets were in fact random and we don't know what the buying and selling pressure is going to do, how could it be possible that we, as students with this mindset, can go in and anticipate these very things happening to this degree of precision? That's unfathomable. It would be impossible. Randomness would cancel that out. It would literally cancel that out. But yet it doesn't. It supports it. And that's why I tell everyone they first come here and they want to argue with me and wrestle. I'm from Goldman. Good. Well done. Come out here and I'll show you what you don't know. The bottom line is this. There is an algorithm. Whether you want to subscribe to it or not, it is. And it's not something to be afraid of. It's not something to be scared of. It's advantageous for you to align your thought process with that. But, it justifies why they're not successful because it's random, right? How can you fault someone when they're not consistently profitable or consistently accurate with their analysis when they subscribe and they try to promote the idea that the market is random? That's a perfect excuse. That's a perfect excuse. That's a perfect out in an argument. You don't have to ever listen to anybody be critical of you. But I'm inviting you, be critical of me. Be critical. You watch me when I live stream it. You watch me when I give you the analysis. You watch when I tweet these things, and I never delete a fucking single tweet ever. And it delivers all the time. Nobody can be this lucky. Nobody. Not in randomness, right? All right, enough. I'm having too much fun today. You guys, you need caffeine to get this high and hopped up. I don't. The markets are my caffeine. All right, so anyway, the market trades up into that 4-hour fair value gap. It just looks like it falls just short of consequent encroachment, but that's okay. Consequent encroachment would be midpoint. And I like to do this, like I'll highlight over top the rectangle I'm drawing. You can see that box right here, that little tab, that's halfway. So you can see it just falls just short of that. But that's okay. It doesn't need to go there. It's better for it to not go there and stay below it. Why? Why is it beneficial for the market to do that? To trade not to it and remain below it, because it indicates it's what? Heavy. And when the market rallied up there, and a lot of you want to know, how did I know to enter right into that? What did I do? I'm going to teach you, but you got to get through all the, the boring stuff. I like to see all the guys tap out early on, the weak ones. I don't like to give all the goods in the beginning of the video. All right, so the market rallies up into that, takes the buy side out. Let me scrunch this up real quick again. So this was the buy side, right above that high. That means anyone short, they would have a protective buy stop there. But the 4-hour inefficiency up here, it's not just liquidity it's going to reach for. Because if it was just that, the market would just bump that high a little bit and then go down. It's not resistance, because if it was resistance, it would just hit that high or just a little bit above it and go down. It didn't do that. It went to where I teach you it's going to go. Price will go up for one of two reasons, okay? It's going to go up to take out a high or relative equal highs for the purposes of engaging the buy stop or buy side liquidity above that high or highs. And in this case here, it does both, trades up to reprice to an inefficiency, which allows for engineering of liquidity. This high now, right here, there's buy stops starting right above that. I don't need a book map. I don't need a level 2, all that stuff. They are crutches. But level 2 is a gimmick. You can spoof level 2, okay? I wish I can remember that guy's last name. It's driving me nuts. But anyway, the folks that promote the idea or try to argue with me in my comment section or tweet to me some bullshit about, you talk about how, you're reading order flow. Show me your order book. Show me your level 2 data. I'm doing all of this literally just with time and price to the tick, precision. Level 2 data, all those orders you see flashing on all that stuff, those orders are not necessarily really going to be there. They're just being spoofed, okay? When you watch those level 2 data, the buy orders, the sell orders that are all at different prices, and you watch that ladder, what you don't realize is you're being primed. Okay? Everything about these markets is just like a casino. You ever been to a casino? In a casino, there are no clocks on the wall, and there's no windows so you can see that you've been there all day long. Now it's daytime. No longer, it's nighttime. They want you to lose sight of how much time you're there. Because a sober mind would be like, you know what? I need to take a break. I'm losing too much money. Let me get out of here for a little while. They want you to get caught up in that loser cycle. Okay? That's what prop firms do. That's what brokers do. They want you to lose sight of your reservations. They want them lowered. Sure, honey, we're going to bring you a beautifully clad woman, barely dressed, come over to you, and they're going to bring you your drink. We want you intoxicated. Get smoothed out. Rough edges. Nobody should have that. Get nice and cozy with this scotch and soda. Put some money in it. Have some fun. You might get rich. You might make some money. How often does that happen? Not often. So when we look at the marketplace, and you're looking at it through the lens of a level 2 DOM, it's DOM, not DOM, by the way, depth of market, that ladder is priming you. Both sides of the equation, whether you're bullish or bearish, they see whatever they want to fucking see in that. If you're bearish, I'm hungry, you probably heard my stomach there. If you're bullish, you're going to make every excuse why it's going to reach for that number because there's a lot of orders up there at that level right there. But what happens when you're wrong and it goes lower? The people that were right at the same time that was looking for lower prices, they're saying to themselves, it's going to go down to that level there because look, there's so many orders. They're fucking both showing the same thing. But they're allowing for you to bring your own interpretation. And those orders are not all real. And you're coming at me with this Mickey Mouse fucking argument. Show me your level 2 data. Show me your this, then. Yeah. Show me you getting to the tick accuracy before it happens live. And then making $13,000. You show me that. Because I don't see it happening. I see every attempt in a live stream trading with real money losing. That's what I see. That's what everybody else is seeing. Make a documentary about that, Benny. Level 2 is a gimmick. Priming. Okay? Priming. There's a little children's game that was done many times when I was growing up. It's done in different ways and such. But they would ask you, like, when I ask you this question, every time you answer, you say white. Okay? What color is snow? White. What color is the surrounding surface of your eye, but not your pupil? White. Okay, with that said, I'm going to ask you a simple question. What does a cow drink? Most of you just started thinking or saying it out loud, milk. They don't. They produce milk. They drink water. That's priming. Same thing with this. Every time I ask you this question, you say shop. Okay? S-H-O-P. What does my wife like to do? Shop. What does my daughter like to do? Shop. What would you like to do if you had a whole lot of money? Shop. Okay, with that said, I'm going to ask you a simple question. What do you do at a green light? Some of you fools, you said stop. You don't stop at a green light, you go. That's priming. I did an example of this in a much more intricate manner on my SoundCloud account, The Illusion of Choice. And I still get emails from people saying, how the hell did you do that? That's priming. Priming is building a rapport with an audience member if you're a magician. If you are a hypnotist, you can prime the person in hypnotism. You can do a lot of things. And already I can hear all the gears turning on all the people that hate me. They're thinking, okay, that's how he's doing. He's hypnotizing his audience. He's hypnotizing his audience. He's brainwashing his audience. Oh man, whatever gets your ad revenue, right? Go do your thing. Christmas is coming. Your kids need to have toys. Do whatever you got to do. If you got to use my name for the shit on YouTube, go ahead. I don't give a shit. I'm still winning. The bottom line is level 2 data is priming. Okay, it's priming. There is no advantage. There's zero advantage of having that, but it looks fucking cool, doesn't it? If you show your screens to people and it has that shit flashing on the side, you feel like you're running the Enterprise. You're fucking Captain Picard, right? You know, you're in there. You got all your bells and whistles in front of you. You're commanding this fleet of high tech real estate. It's all bullshit. It's all bullshit. Open, high, low, and close. And what time of day is it? That's it. That's all I'm doing. That's all I'm doing. Buy side liquidity, sell side liquidity, inefficiencies, and I'm building a narrative that I outlined yesterday live. No level 2 data required. No order book, no map book, no none of that horseshit. Okay. Above every single high and below every single low, there's going to be liquidity there. How do you know how big the liquidity is? What time frame are you looking at? This is an hourly chart. I have a lot of emphasis placed on an hourly chart because it's an integral part of intraday price action because it's a significant time. There's only so many hours in a session. So if you see a high that's on a 60-minute time frame, it's going to be significant. It's a very significant aspect to determining what level of liquidity you should be focusing on right now, which is why I gave my son Cameron. He has to aim for an hourly or 15-minute minimum pool of liquidity. There has to be something he's aiming for either the hourly preferably or the 15-minute time frame. So how would you use that information? I'm actually writing a book here today, by the way, in case you haven't noticed. It's audiobook. So this was the draw that we were outlining yesterday live, okay? And that was the reason why I was saying I was going to go up there. But I wasn't limiting it to that. I told you to look past that level because I'm not a fucking support resistance trader. We go to it and through it. Where is it going to go, ICT? Up into this shaded area. How far can it go? We don't want to see it trade to the half of it and higher because then it erases its effectiveness as a indication that it reached up there just to go lower. Because if it went all the way up here to close it, that's a little bit problematic for me. I want to see it go there and stop at or short of the halfway point. If it avoids going in the upper half of it, that's exactly the signature I'm looking for and requiring of that PD array. That 4-hour fair value gap that's shaded blue here, that very idea of it not getting to the halfway point or consequent encroachment of it, it failed to get there. That's what I liked about why I entered. What? That's exactly why I entered. Because this run up here, when it was running up there, it couldn't jump right to the halfway point. It stopped short of it. That was the very signature I was looking for. And on the very next 1-minute candle, which you watched me record live, it's happening right there. It's not market replay. Live execution based on everything I outlined in front of all of you live yesterday. There you go. If that's what we were running, the liquidity over here above this high, and we can frame how far past that high it can go, because we're not supporting resistance, we're not trading with that bullshit, we're trading into an inefficiency up here. So if I go back and I add, I can use those 2 candles there, thank you. I was wondering if I had to go back up to the 4-hour, but I can see I can use these 2. That's the halfway point, okay? I'm going to add the lower, the lower one there. So what I'm showing you is these are the 3 very specific levels. I don't trade in supply and demand zones either. That's not a fucking supply zone, okay? That's not a supply zone. It's not a supply zone. I don't give a fuck what anybody else calls it. That's not what that is. I do not trade Sam Seiden's bullshit, okay? Online Trading Academy, all that stuff, that's a wonderful beginning. It's a beginning. I don't subscribe to that stuff. Everything I teach is fresh. They only teach a fresh zone. And where in that zone are you going to trade? Who the fuck knows? I know where I'm looking to trade. In this area here, in using this 4-hour inefficiency that's shaded off of a 4-hour chart, There are 3 very specific price levels. I'm showing them to you. Okay. Now I'm going to go one step further and give you a chapter in a book on this very topic. Okay. You don't want to be here too long? Get the fuck out of here. You want to learn? Get the fuck out of here. But this is how you're going to use this information. Okay. Everything that I said yesterday live, everything that I was explaining to you, why and where it should reach to, this is the amplification of it. This is the part that experience was telling me I'm waiting for these very things. Midpoint, which is consequent encroachment of that 4-hour gap. Okay. We and I didn't want to see it trade above that. So in other words, this is what we don't want to see. We don't want to see price trade into this area. This is the stuff people would pay money for. Okay. Trust me. That shaded area there, that's not blue. When we are looking for it to go up, to go down, and it's trading into an inefficiency, this is the logic, okay? This is what the algorithm is doing. This is how people that understand what the algorithm is doing, how they engage with it. The smart money, the real smart money that are not going to be out here like I'm doing it. I'm rogue. I'm doing what the fuck I want to do. I don't give a shit. Tell me I can't, I will. Over here, price is trading above that buy side liquidity pool here. So in context, for you folks that want to screenshot stuff, so you're journaling. See how nice I am? I'm doing all the legwork for you. I know, I love you too. So it's going to the buy side here, but that inefficiency, that shaded area here, that's 4-hour, there are specific price levels, which is the low right here. It's trading to the low there, stops short at the low of what? The 4-hour inefficiency. That's fucking random. Then the next candle, it does what? It trades up into the lower quadrant, but watch, fails to get to that halfway point. Beautiful. Woo! That's exactly what I'm looking for. I'm looking for that. That's the very thing, because I don't want to see it run real quick into halfway point and above it, because then I'm wrong. What would happen if it did that, ICT? Would you trade short? No. I'm going to wait for a shift in market structure later on. Model 2022, something to that effect. Okay. Holy cow. What I just gave you is how you differentiate when you run and trade a turtle soup, which is what you watched me trade live yesterday. That's turtle soup. That's my rendition of a turtle soup. That is not the Street Smarts book written by Linda Rasch and Larry Connors. The inspiration, the understanding of a stop raid, I learned from that book. But what I teach, I call it, fondly, and it's a term of endearment, kind of like it's a nod to the influence. And I've never shied away from this. That book helped me understand how to trade a stop hunt. Whereas I never looked at trading with the view of going into the marketplace, trading with a stop loss of someone else as my entry mechanism. I always looked at a stop loss happening to me as a victimizing of me. That was the perception I had of it prior to that. So the paradigm shift I had by reading that book, Street Smarts, which I think every one of you should have. It's a wonderful book. It gives you the mindset of taking a model that can be extremely simple and only trading with these conceptual ideas applied to a very small set of rules and sticking to it, accepting that it's not perfect. And if you do that, regardless of whatever it is, it'll give you the foundation that's required to be a systematically, consistently profitable trader. Because you have to have a baseline somewhere, right? And I was in there doing all kinds of stuff. And that book gave me really simple little strategies. I don't like everything in that book, by the way. I liked the anti-pattern when I liked using stochastic. I don't like stochastic. I don't like any indicator now. But it was giving me these little things that I could work with and study, where I had no idea what to go in and study. Like many of you see all these videos I have, all these tools, this terminology, this language, and it's overwhelming. You're like, man, where do I begin? Go to Model 2022 playlist. It's 41 videos. The first one is kind of like just building your expectations. It's boring. But if you really want to be a student, listen to it. And that will give you the foundations to go in and start looking for things that repeat every single fucking day. Every day it's there. And then if you want to learn a little bit more, watch the video I did for the silver bullet. It's one video. It's just one of them. And it'll teach you a time-based trading element that is very specific. It doesn't have a lot of moving parts, but it allows you to go in and start having something that you can measure progress in. You can go in and back test. Does it really exist every hour? Every day between 10 o'clock and 11 o'clock? Yeah. But when I'm looking for a raid of buy side to sell into, which is scary, I know. When you first start trading, it's very, very scary to do that. Because how do you know it's not going to keep going? Well, that's why you use a stop loss. What? You're just going to trust it like that? Yeah, that's what 30 years does. 30 years doing something, you get a callous to it. You just don't feel the same fear and apprehension that you do as a new student. But I'm cognizant of it. I'm sensitive to it. And I teach you how to overcome it. And I do Twitter spaces where I cuss at you because I remember what it was like for me. And I get pissed off that people are fighting me when I'm giving you the best advice for free. And I'm proving it with real fucking money. And I have a big community with real results, with real money. And everybody is ignoring that. It's madness. It literally is madness. I have a mental illness, but I think the people that argue and deny this has a bigger mental illness. They're denying the obvious. But the idea of running into liquidity for the sake of fading it, using it as counterparty, handshaking with it, okay? That's what smart money does. I illustrated that to you yesterday. I outlined it. But these 3 specific price levels is what I was looking for. And the very thing I wanted to see was, number 1, do we gravitate towards it? Yes, we do. Do we trade into it? Yes, we do. Do we reach the lower quadrant of it? Yes. Do we trade into the upper half of it? No. It stops short of it. Hello. That's exactly what smart money looks for. That's the waiting point. That's the billboard sign when you're driving down 95 and you're looking for the exit ramp for gasoline, the indicator that, hey, this is the time you got to take the initiative. You're low on gas. You got to go over here. It's the prompting, okay? Because smart money does not have fucking indicators on their chart. They are not looking at level 2 data. They don't have depth of market, ladders. They don't have book maps. They don't have indicators at all on their fucking chart. They're looking at time and price. High frequency trading algorithms are looking for this signature here that engage with the algorithm that books price, that controls price. It's rigged. It does what it needs to do based on a script. It's like a fucking video game. It has boundaries. It's not going to go here. It's not going to go there. It's going to do everything it's going to do in that range until manual intervention. Manual intervention will take it out of autopilot. And then you'll see this massive repricing higher or lower. What does it look like? How does that visible in price action? Rate announcements, unexpected rate announcements, non-farm payroll, CPI, all these big red folder events. They are times when they're signaling that, hey, the algorithm will do what it's going to do. But these are times when it's advantageous to us, to upset sentiment or engineer new sentiment in the marketplace, to inspire interest in a market or dissuade folks from being so interested in another market. Manual intervention comes in and they will manually reprice to a level. And that's why you see these sudden, like, what the hell just happened? That thing just moved 100 plus handles in 1 minute. Yeah, welcome to manual intervention. You can't trade that. You can't predict that. You can anticipate the season, the climate, the conditions where it will materialize. But in fact, every single day it can happen. They could come out on Monday and do an unexpected rate hike. Who says they can't? Who says they won't? With all the shit that's been going on the last 3 years, you don't think they ain't going to pull some Mickey Mouse shit? They're going to do crazy shit. Okay? That's why your risk needs to be lowered. to more tolerable means where that way you're not getting wrecked by any one particular trade or event. But you're all trying to push the envelope and try to make it real big so that way you can smash it. And the only thing you're finding getting smashed is your equity curve and your accounts blown. There's a right way and a wrong way. So I'm looking at a inefficiency that is not a zone. I'm taking that inefficiency and I'm dividing it into 4 equal quadrants. The highest high, the lowest low, the midpoint. Well, that's 3, right? And then you have, oh, it's 5. It's 5 levels actually. Then it's the lower quadrant of it and the upper quadrant. Okay, so it's 5 very specific levels. But when I'm bearish, I don't want to see the upper half traded into. When I'm bullish, I don't want to see the lower half traded into. And if I'm watching a price run at a time on the economic calendar and it reaches into these inefficiencies, imagine how hard this would be to communicate in a book, by the way. And then not have the example of me doing it live yesterday. It's very complex, isn't it? And this is why I didn't write books sooner, because it takes a lot to make it understandable. Because if I just tried to do what I feel I would have done if I tried to write a book only and not do it live in examples where you see me doing it, entering it with a stop loss, managing the positions. That's why I do all those short little vignettes on Twitter. So that way you can see that these things repeat. There's a logic behind it. I know how to trade. It can be transferred to you in logic. Using the same logic, you can do these types of things too. You won't be perfect. You'll lose money eventually. You're going to have losing trades. Everybody has losing trades. But you have to have something to base this belief in. You have to be able to, if it's believable, you'll spend more time trying to do it, right? And that's why I show the examples. And I try to teach you to trust yourself and allow for enough time for you to learn how to do it. But the aspect of it not getting to the upper half of that, that's important. That was the indication to me. It has nothing to do with a DOM, nothing to do with a depth of market ladder. It has nothing to do with volume profile. It has nothing to do with Elliott waves, nothing Wyckoff, nothing supply and demand zone, none of that stuff. It's this. This is what I'm talking about. And I'm challenging you. You will not see this anywhere else until I talked about it. It wasn't in existence, okay? So when I talk about it and I'm very dogmatic and I sound like I'm bragging and I'm talking down to other traders, I'm defending my position because you have no idea how many times I'm getting emails from people that say, look, I found your YouTube channel. I like this, but I see this guy saying that you failed 4 times in the Robbins Cup, and that's fucking bullshit. I've never failed 4 times in the Robbins Cup, and I will beat your fucking ass, Vinny. If you please, just get your ass on the leaderboard and call me out. You won't do it because you can't fucking trade. Vinny E. Mini bitch, Vincent March of Allen, Texas. I will say your fucking name. I ain't too scared to say it because you're a little bitch. Motherfucker, let's go. Caffeinated yet, motherfucker? So the buy side here was the attack. The target was the inefficiency. The indication that it's turning was that it didn't go to the consequent encouragement. Okay? It failed to go there. So now we can start dropping down to a 15-minute time frame. Oh, let me go back up to the hourly. I'm sorry. I forgot to mention this point. If you want to consider using the idea of the 15-minute and or 60-minute liquidity pools for draws, for intraday scalps or intraday trading, as soon as it went up into this level here, as soon as it did that, and we're bearish, and as I was outlining, I would be, and you should be expecting it to do that as a case study to watch it live yesterday. As soon as it did this, and if it starts to go lower, where would your focus immediately go to? Sell side. Where would that be resting at that moment? As soon as it did this, right there. I guess in a way, market replay would be helpful here because if I could have the candle looking like it was bullish right there, and it didn't have this down close candle already there, it would be helpful. But your eye should drop right to that low. That's where sell side is. Okay, and then it's this, and then it's this, and then it's this, and you have this inefficiency down here. Okay, so that's how you would note all the liquidity pools. As soon as the engagement of that fair value gap on the 4-hour and we get the failure to get to the halfway point. Now you can do this on higher time frames, but if I'm trading turtle soup ideas where I'm selling buy stops, I'm using this criteria right here. And my private students did not learn this before today. They're learning it just with you right now. So stop believing these people that are selling you bullshit. Oh, here's the unreleased mentorship videos. If you believe that bullshit, you deserve it. You deserve to be fucking conned. Because I've already told you it's for free on my YouTube channel. And I'm teaching for free now. Nothing future selling. I'm not putting a price tag on anything. It's done. And I'm only writing books so that way it's codified in history that it's my shit. Nobody else did it. Me. And it's a gift. All right, so anyway, now we can drop down to the 15-minute time frame. This was supposed to be a short live stream. Shut up, ICT, just keep going. I'm here for all day. Go. All right, so when the price runs up, again, it fails to get to the halfway point. That's what this little pink level is here. So we're going to take this lower quadrant level off because it's already too many lines and it can be confusing. So it fails to get up there. On a 15-minute time frame, you can see it reaches up there, and then immediately we start to break lower. What's the 15-minute time frame showing you once it gets up here? Where's the first draw on liquidity? That low. Look how fast it goes to it. Boom. See that? Real quick. Then we start to chop around in here. Stop would need to be above consequent encroachment. Why that level? Because it's the low of the 4-hour inefficiency. It is the consequent encroachment of that wick. So there's what? There's 2 PD arrays. No, 3. This up close candle, that closing price is a rejection block. So it can punch up here to run above that and then reject price, go lower. But what happens if it wants to go past that? How far can it go? This is a confluence of 2 different things that are on the same level. Otherwise, I would look at this consequent encroachment of that wick. Why did I skip over that? Because some of you are like, oh, he just read my fucking mind. How about that? By the way, don't wear that shirt. It doesn't go with your pants. This consequent encroachment of this wick and the low of the 4-hour chart, fair value gap, that agreement of the same level, I'm going to use that over anything like this secondary lower consequent encroachment. But prior to that one, moving my way up, this rejection block, consequent encroachment of that wick and the low of the fair value gap, your stop loss needs to be above that. Okay, and you can weather all this bullshit here, and the market eventually breaks lower, takes another swing low out on the 15-minute time frame. That's a scalp. That's a high frequency trading trade there too as a target. What is this right here? Sell side on the 15-minute time frame. Remember, we're looking at a 15-minute time frame. So all these levels are salient. There's significant draws for liquidity. So as I'm watching price, as you're watching price, you'll look to see, does it have a willingness to get down to these levels? And how does it behave once it gets there? Now, yesterday, like I am right now, I'm hungry. So when I end this live stream, I'm going to grab something, then I'm jumping on Twitter to do the Twitter space. But I'm hungry, and I was very hungry. And my wife had texted me saying, look, let's go get something to eat. And that was enough invitation for me to say, you know what? I'm going to run down there and grab something to eat with her. Took my laptop down there and I sat at the bar of my kitchen and ate my Belgian waffle and traded short. This low right here is a sell-side liquidity pool too. We see it draw into that. Then we see this inefficiency. All this drop down here, where's the fair value gap? From this low up to that high, where's the fair value gap? This one and this one. So if you were down here and you're watching it trade up there, you have to do what? Think about the logic I gave you in the 2022 model. If you have 2 fair value gaps, you have to allow for the market to reach into the higher one too. So yeah, you could have entered on this right there and it dropped down. You're probably thinking, rock star. And you had your stop loss right there. And then it came up and hit you, knocked you out, and then it ran. Logic is you have to allow for that secondary fair value gap. I needed to get stopped out. Otherwise, I would have did the whole range. And my wife would have been mad at me because I would have been having my attention on this and not talking to her, like, because she likes to talk while we're eating. That's one of the things about my wife I wish she didn't like to do, because I like to eat and get done, and she wants to chit chat. And the chit chatting, because she's eating, I'm eating. I'm trying to get the meal done while it's warm. Okay, I don't like to eat cold food, but she don't mind it. She'll just eat and talk and talk and talk and talk and talk, and that's the time where she's chatty. Anytime when we're not having food, she doesn't. She's not real chatty. I'm always doing the talking, but that's her time. So I don't know why I'm throwing that in there. It's no extra charge, but I'll just let you know I'm married and I have to be submissive to her when she needs my time. So there you go. Anyway, the market runs down, takes out the London low right in here, which is what I outlined yesterday in the live stream. So I said we were going to go up into this inefficiency at 10 o'clock, use that news driver to drop down and erase everything from the London low. And all this movement higher, they would erase that. It did. And for good measure, it's got this low and got real close to that one, didn't it? Doesn't look like it got it though. Is it equal? The low is 1125. And the low is, oh yeah, it did, just by a tick. There you go. That's enough for government work, right? And then off the low and then consolidate and goes into the close. So if you look at how on the 1 minute chart, I'll say this and then we're done. It doesn't mean I'm done with you today. It just means I'm done for YouTube. I'm ready for the Twitter space now. All right, so it goes up and it falls short of reaching consequent encroachment of the 4-hour fair value gap, which is that shaded area up here. So as soon as the next candle opens, as soon as that next 1 minute candle opens, I'm in there. I'm selling short. A stop loss is placed. I trust everything. What happens if I get stopped out? I got stopped out and I'll look for a new entry. I was trusting that we were going to go down yesterday. And if I would have got stopped out, just like you've watched me do, I think 2 examples of it this year where I got stopped out in trades and re-entered using the same logic, or when I got stopped out, I reversed and went the other direction. So I shared me getting stopped out. Okay. I've been stopped out in profit in some of them too, but I'm talking about where I've been stopped out wrong about what it is I was trying to do and still getting in and working with the logic or reversing it and finding another profitable trade. So I'm not fearful of sharing a loss. Excuse me 1 second. I'm parched. I'm not fearful of showing a losing trade. I'm not fearful of showing frailty as a human being, because as an operator in this, I can bring emotions. I can bring aggression. I can bring anger, hurt feelings. When I lost a pet, if I was doing a lot of trading then, I could have done things, inadvertently and caused harm to my equity. So you have to be aware of those things. But losing trades and getting stopped out does not cancel the underlying premise behind why you took the trade. Now, not all the time. Sometimes it does. And in those instances, you need to identify, okay, yeah, this changed everything. The trade's no longer viable. But if the underlying trade is still there and it's viable, that means I think it's still going to deliver like I initially thought it would. I just made the error as a human placing the stop loss in the wrong place. If I get stopped out under those conditions, okay, no problem. I'll worry about what I did wrong later on. The trade's still there. I'm taking it. So as long as I didn't take my full maximum percentage loss for the day, and I'm not talking about, funded account trading stuff. I don't trade that stuff. But whatever my risk would be that I'm accepting as the maximum for the day, if I hit that number, then I have to drop and do less risk, half of what I used the initial time. But if I haven't taken my full, whatever my maximum risk for the day is, and it's all determined on like what I was mentioning earlier, if it's everything going in my favor, I'll trade with 4.5 to 5% max, but that's competitive level type trading. Like I'm in there to beat the shit out of something or measure myself against something just so I can say I said so, and you can't do it. Generally, it's 1.25, 1.5% to 2% ish, something like that. When I'm real comfortable but not overconfident, it's anywhere between 2.5 to 3%. But generally, if I'm going to take a trade, it has to be something I'm willing to take 1.25 to 1.5% risk on. If I don't feel comfortable doing that, chances are I'm just going to let it pass, and I'll talk about it maybe, but I'm not really in it. But if it's above that threshold, like if it's in an area where I feel comfortable, I'll risk 2.5 to 3% on. Then at that point, I start weighing out, like I was showing you and teaching you this earlier when I was using the market maker sell model. Is there things that would be an impediment to me feeling confident about risking 4.5 to 5%? That is not an invitation. I'm not trying to tell you to risk that much, but I'm teaching you how my mind works and how I assess trades and how I assess risk. When am I willing to assume larger risk? You should never be risking more than 1%. There you go. I said it. Okay. But when I talk about what I'm doing with my money, that doesn't mean that you should do the same thing. I'm willing to take a larger loss knowing that I can get it back. My losses are usually limited to about 1/8 of what I can make generally as the high end of a day. So let's just say I'm willing to do a specific model, and I know that model can yield me $15,000 in a day. That's a trade. That's not a series of trades and losing and winning and losing, and then finally getting to a $15,000 payout for the day. I'm saying I have models that I know in one pool, one single pool, no partials, I can pull $15,000 out with that model. So I have to take that and divide that in 8 pieces. In 1/8 of that, that's what I can risk. You don't hear that in Ryan Jones and oh no, I'm embarrassed. I can't remember his name now. I'm getting old, aren't I? I'm having a senior moment today. I can't remember the guy's name. Oh my goodness, I'm so embarrassed. I can't remember this guy's name. Ralph Ince. Sorry, Ralph. That's not in his books. But that's one of the things I used also when I was running those MT4 Forex accounts. Okay, everybody likes to pretend that they were a MT4 server, rented server, something fake. No, I was using high-end, high risk money management. And I was doing what you see me doing here every fucking day, every single week, every single month for years now. Okay, some joker said on Twitter yesterday, said, "Oh, this is all great, but show you can do it 21 times out of 30." And I facetiously said, how's 6 years in a row? When it's technically 7 years. I've been doing it in the presence of a community that watched me do it every single fucking day. See, I'm doing things that I used to do all the time for people that paid me. I was outlining the market every single fucking day, and it was to the script all the time, every single day. That's why none of them came out, and I invited them, show the videos where I did it wrong, and it never fucking happened. Isn't that interesting? Even the people that don't like me never came forward and said, here's the proof it didn't happen. Because it never happened like they want it to be. They want it to be where I'm a con artist. I'm doing something surreptitiously. I'm lying to you that this stuff works, but I'm proving that it does. And my students' proof is enough. I didn't want to leave it in the hands of just my students. I had to come out here the last 2 years to prove to you fucking clowns that this is next level stuff. They're going to write books about what I've shared to the public long after I'm gone. Long after I'm gone, they're going to be writing books about everything that I've proven. And to be honest with you, it's kind of weird. So anyway, when it broke down here and it created this sell side imbalance, buy side inefficiency, as soon as it traded up into there, I added to it. That was a pyramid entry. So what about this inefficiency is good that we like to see? I'll give you a second. I'll look at it here while I get a drink. Remember, the context is we're bearish. We're looking for lower prices. What were we aiming for? A run completely over top of the daily ranges progress and what they've put in place since London's low. So this move from here to here is not the entirety of the move. But because I have a wife and I have a family, I had no intentions of really trading yesterday, but I saw an asshole talk some shit. I had to come out there and bring some receipts. So this inefficiency here, we want to see part of it, just the portion of it, the upper part of it, we want to see it stay open. Okay, that's the full fair value gap. The sell side imbalance, buy side inefficiency, that drop here, that drop to be perfectly repriced. This is not balance. This is not a rebalancing of price. Okay, if it goes all the way back up and touches the low of that candle right there, that low, let me take this back off. That candle's low right there. If it touches that when it retraces, all that is a complete repricing. That is not rebalancing. Okay, the price is not rebalanced until it leaves that range. What does that mean? Here is the inefficiency. Price trades into the inefficiency and then leaves it. When does it leave it? Right here. How do we know that? Because it moved away and took out the structure low that used the retracement into it. So it definitely left it on that candle. Then it came back and touched it here and had a little tiny little mohawk touching into it. One tick. Did it have an interest in getting back to the midpoint? No. That's wonderful. That means we're heavy. Also, more specifically, this was the original fair value gap, right? This is the portion that didn't close in and reprice to. What is this? So some of you, insignificant. You would never pay any attention to it. Wouldn't be anything of any consequence to you. It's just, whatever. Just never paid any attention to it, right? To me, that's a breakaway gap. It did not completely reprice to that candle's low. I like to see that. That signature is a algorithmic confirmation that we are going lower. We're going lower. And when we broke down on this candle here, see, when we look at it like this, when you're looking at price at like this, okay, it's hard to appreciate the fine details I'm showing you in this little area here until I point them out to you. But when you go back and look at all of my executions, all the ones that I publicly recorded, and you might want to go out and start downloading them now because Twitter's a bunch of bullshit. They're putting copyright claims against the music because I guess they think I'm monetized, but I don't have a blue check mark, and I would never have a fucking blue check mark because I don't want my tweets able to be edited. I've never edited a tweet, and I've never deleted a tweet. Whatever I've said. It's out there. It's public record. It is what it is. And I'm not taking my Twitter down when I leave November 11, 2023. But when I leave it, I am never coming back to fucking Twitter. I came there for 2 years, and the little bitch down in Texas never showed up like I promised you he wouldn't do. And now it's proven. I'm done with Twitter. I won't go back. So the details in here, once you start looking for them, go back and look at all my other executions, and you'll see these signatures are there. I'm trading with this logic in mind. I like to see things delivered to a specific level, but here's another side of that. I like when the things that would be normal to see it trade back up to this low, to reprice to it, that would be an efficient market. Not inefficient, it would be efficiently delivered price. For it to completely overlap this and touch that candle's low right there, if it would have done that here or any of these candles, that would have been a completely normal function of an efficiently delivered price. But if we're bearish, we want to see it fail to be efficiently delivered back up to that level. Because if it does that, it's indicating by default that it is underlyingly weak. Not that it didn't have enough buyers. Not that the sellers came in too much. There's no fucking buying and selling pressure. That is a myth. It's a fucking myth. You're worried about trying to figure out what the buying and selling pressure is. The whole time you're watching the left hand, the right hand's doing the sleight of hand. That's what you're doing. You're falling victim to this shit. And I'm trying to tell you, this is what's going on. Focus on these things. Stop looking at the distractions of bookmap and fucking level 2 data, DOMs, volume profile, all that bullshit. It's bullshit. Stop looking at that stuff. You're being distracted. You're never going to pay attention to the details that matter if you're looking at that dumb shit. None of that fucking shit works. None of it. If you did something that made money, you're subscribing to that as a fucking religion. You believe that that was the catalyst for you being right. And you believe it. And you keep telling yourself, but that had nothing to do with why price did what it did. I swear to you, there is nothing on my fucking monitors that are telling me secret information. I'm literally reading the open, high, low, and close at specific times under the pretense that it should run to liquidity or inefficiency based on a narrative that I literally walked you through minute by minute yesterday live. That's what it is. That's understanding the market. That's understanding price. That's basically reading the future, predicting the future, reading the minds of billions of fucking people all around this spinning rock and what they're doing in this market. How are they going to perceive it? And what am I going to do against their perception? It's fascinating when you think about it like that, isn't it? It's much more entertaining and engaging than, let's see what these numbers flashing on the random series of price levels. I hear that it's supposed to be what all these high-tech guys at the institutions, these institutional traders, these Goldman Sachs boys, these city traders, these interbank traders, they have these tools. This is what helps them do it. They don't fucking use that shit. They don't use that, man. I'm telling you. Top tier traders, and that's above Goldman. That's above Citi. You don't see their faces. They don't have nameplates and tags and social media accounts. And that's I'm the only one out here that's teaching this stuff. You're not supposed to know this. And the way I'm teaching it is not the way it really, really is. But it's real, real close. So close, it gets me right under the radar. And it pisses them off. But the cat's out of the bag now. And no matter what the fuck happens, it's already done. It's already done. You can't undo it. You can't call it back. And you're not going to tear down the whole fucking show to do something new with it. And that's why all you're freaking out. You're thinking, oh no. ICT's let the cat out of the bag, like he said. Now they're going to have to change it. They're going to have to change the open, high, low, and close. They're going to have to change how prices go up and down, and a rush to get to a specific level leads in inefficiency because it's always going to be there. Always going to be people trading with a stop loss. You might not trade with a stop loss because you're reckless. But people out there with real money, with real risk, they're going to use a stop loss. And guess where they're going to put it? Always above old highs or above an old high. Below an old low or below old lows. They're always going to do that, folks. That's never going to fucking change. That's never going to deviate from that. Markets are going to move real fast in one direction. And you're going to be able to determine on a longer term basis that it's going to go to a specific price level. And it's going to rush to start moving there. That's a false start. This is a false start right here. Boom, real quick. Oh no, let's get short. Chase it. Oh no, it's going to go higher. And then they get out or get stopped after they use a stop loss. And then it breaks lower again. What is this market doing? Nobody knows how to predict price. It's just rigged. It's random. It's this. It's that. I got to get a higher membership on my level 2 data. Oh, shit, it's so delicious. I can't stand it. Anyway, I've gone on enough today. I've had so much fun this morning. I've had so much fun. Hopefully, I haven't offended any of you to subscribe to all that bullshit. But I promise you, if you put the work into the things I'm sharing, and I'm sharing it with real fucking results, folks, because there ain't nothing you can say anymore now. You can't say shit anymore. Real results, real students, real money, real record of me doing it, showing it to you, outlining it, proving it to you. Oh, every day, week after week, month after month, now years after years, 7+ fucking years this August. I had a private community that watched me do this. A legion of motherfuckers that literally could have came out here at any time and said, this is what he said was going to happen and didn't. They shared my videos all over the place, just like good little employees. And that's what made me viral. Don't share my videos. Don't you share my videos, knowing damn well they're going to share my fucking videos. That's how I advertised. That's exactly how I did it, folks. No paid advertisement because my shit sells itself. No coupon codes. I don't have to give discounts. I raised the price. And people still beating on the door. Please open another one up. I'm teaching for free, showing it, giving it live, and they're begging me, please let me pay you to teach me. What does that tell you? That means that they see something that works and they think I'm holding it back, and I'm not. I promise you. Folks, listen. Listen. If you are a mentorship student and you're in my private group, no matter what user group you're in, I don't give a fuck. Tell them in the comments, in the post I tweet to on Twitter for the Twitter space I'm going to do, you tell them that you are a mentorship charter member. And you tell them if I am or am I not making fucking videos for you right now. Am I ongoingly teaching publicly? Yes, I am. They are not getting something secret. I hang out with them once in a while, very briefly, because my time's been consumed with this, but they're going to get more of my time after November. Not so much because of the holidays, but next year, my time is spent with them, answering questions. I'm not making videos for them. Because if I make a video there, the assholes that are still in there that want to sell them, they're going to try to market them. I'm not marketing shit for them. I'm not going to produce content for them to sell. Fuck them. Starve, motherfucker. I came out here for free to kill all that shit. I don't need to sell mentorships, okay? And when I stop making videos on YouTube, you're going to see I don't need that fucking ad revenue either. What are you going to say then? Oh, he was right. He didn't come back. You're fucking right. Everything I do is for a reason. Some of you just don't want to see it. You don't want to accept it. And I don't understand. Like, I don't understand why you wouldn't want to seize the opportunity and make the best of it instead of wasting time arguing about dumb shit. Dumb shit. But opinions are like assholes. Everybody has one.